service industries, all those are related. So we have marketing also deploying the skills of qualitative analysis. The fourth one we have here is what we call
perfect information. And the expected value of perfect information can be.
Greetings and welcome back to the lesson. I'm glad to have you at the Manifested eLearning platform. We continue with the subject governance and compliance audit. Today we are still on the sixth topic. We are going to study in today's lesson materiality at the planning stage. Materiality at the planning stage. And candidates, in the context of governance and compliance audit, the materiality is a fundamental concept at the planning stage, but it differs significantly from its application in the financial audit. And instead of focusing on monetary values to determine materiality, it's about identifying and prioritizing risks and issues that are significant enough to impact an organization's governance, reputation, and ability to meet its strategic objectives. Those of you who have studied the financial audit will recall that the way we apply materiality in a financial audit is not the same as we apply materiality in the governance and compliance audit. I've said it differs significantly from its application in a financial audit. So then, what is materiality in a governance and compliance audit? That's a very important question for us to answer before we get into the key factors for determining materiality at the planning stage while conducting a governance and compliance audit. So I come back to the question. What is materiality in a governance and compliance audit? Now, materiality in a compliance context is the threshold at which an issue of non-compliance or a control weakness or a governance failure is considered important enough to warrant attention or remediation or even reporting to senior management and the board. That is to mean that materiality in this context is the measure of what truly matters to the organization's stakeholders, including regulators, customers, employees, shareholders, name them. And a minor one-off deviation from an internal procedure might be immaterial, but a systematic failure to comply with a key regulation could lead to a massive fine or massive reputational damage, which is highly material. You understand that example, candidates? That a minor one-off deviation from an internal procedure, because an organization is required to adhere to internal policies or procedures and also external laws. So a minor omission to comply with an internal procedure or policy could, in a way, be immaterial, not critical or not important. But if there is a systematic failure to comply with the key regulation, it could be applying certain regulation or industry-specific regulations or any other form of regulation by the government, that could lead to, that could be highly material. It could lead to reputational damage, which could be highly material, and so on. So that is the meaning of materiality in the context of governance and compliance audit. So in this lesson, having understood the meaning, let's identify the key factors for determining materiality. Key factors for determining materiality. What are the key factors that determine materiality? Now, these key factors, we can categorize them into two: the qualitative factors and quantitative factors. We may have and these are the most important factors in the context of governance and compliance audit. Quantitative factors. These are the most important factors. Now, qualitative factors are often the primary drivers of materiality in a compliance audit. And these are non-monetary elements that can have a significant impact on the organization. One such factor, this is 1A, is legal and regulatory impact. Legal and regulatory impact. This is the most critical factor because a single instance of non-compliance with the law or regulation can be highly material regardless of its financial cost. And the potential for fines, lawsuits, or regulatory sanctions make legal and regulatory impact a priority. It makes it a top priority. Here we are talking about non-compliance with the data breach, data protection laws, environmental violation, a breach of major contract, and so on. So this is the first qualitative factor. The second factor is reputational risk. Reputational risk. Now, here, candidates, any issue that could damage the organization's reputation and public trust is material. And this includes ethical lapses, data privacy failures, or even misrepresentation of product information. So a reputation crisis can lead to loss of customers. It can lead to loss of brand value. It may also lead to loss of market share, which can be far more damaging than a direct financial loss. So reputation risk is also a qualitative factor. The third key factor for determining materiality is strategic impact. We check what will be the strategic impact. Strategic impact. Because a weakness in governance or a weakness in, say, compliance or failure to comply with the standard that could hinder the achievement of a key business objective is also material. So a weakness in governance or a failure to comply with the standard that can hinder the achievement of a key business objective is also material. For example, a weakness in the ICT or IT controls, a weakness in IT security control that prevents the launch of a new digital product can be considered a material issue. So we are looking at the strategic impact, which is also a key factor for determining materiality. Another key factor for determining materiality is the control environment and culture. Control, environment, and culture. Control, environment, and culture. These are issues that indicate a pervasive breakdown in the control environment or just a culture of non-compliance, which could be highly material. If the company has a culture of not complying with laws, and regulations. If the company has a culture of not complaining, of not complying with laws and regulations, that can be considered material, right? Because a small error might be immaterial on its own, but if it is part of a pattern that suggests a lack of management oversight or an intentional override of controls, then that can become a material issue. Number 5, we may also consider the impact on stakeholders. Impact on stakeholders. This is also a qualitative factor. Impact on stakeholders. Here you consider the impact of the potential impact on the various stakeholders, including customers, employees, investors, and so on. Another good example here is failure to meet workplace safety standards, or even if it hasn't resulted in an accident, that may still be considered a material risk. A failure to meet workplace safety standards, even if it has not resulted in an accident or an incident, that is considered a material risk. So these are 5 qualitative factors. Let's analyze the quantitative. What are the quantitative factors that determine, that help to determine materiality? Now, while these quantitative factors are less dominant than the financial audits, right? While quantitative factors may be less dominant than in financial audits, because qualitative factors are very dominant in financial audits, while they may be less dominant candidates. The quantitative factors still play a role. Okay, they may be less dominant, but they play a major role. They still play a role because they are often used as threshold to help the focus the audit team's attention. And one such qualitative factor is the potential for fines. The potential for fines and the potential for penalties. Potential for fines and penalties. This means estimating the maximum possible fine for a compliance violation. When determining materiality, the auditors may check the impact of not complying, the financial impact of fines on or penalties of failure to comply with laws or regulations. Estimating the maximum possible fine for compliance violation. And if a regulation like the Data Protection Act allows for a penalty of, say, up to 4% or 5% of annual global turnover, then a potential violation of that rule would be considered highly material. Because, you know, in legislation currently there are always penalties and also fines that are imposed on companies that do not comply. So to determine materiality, the auditors may check if, for instance, the company is not adhering to data protection laws or even the Company Act laws or provisions. There are fines that are indicated that such companies are required to pay. So the fines, if they constitute more than 5% or thereabout, then that may be considered material. Another quantitative factor could be the cost of remediation. Cost of remediation. We may also consider the cost of remediation. This is the cost to fix a non-compliance issue. Because if the auditors have to find, or I mean, if a company is not complying with certain laws, then that non-compliance may be required to be fixed. And that fixing comes at a cost. And this cost can be a material factor. So if a systematic failure requires a significant, for example, investment in new technology, training or just personnel, then the issue is considered material. So cost of remediation is also a quantitative factor. 3, you may have loss of revenue. Loss of revenue or loss of market share. Here, candidates, the potential for a compliance failure to lead, this is the potential for a compliance failure to lead to a loss of key clients or even decline in the market position, which can be a material consideration. You understand? Yes, so here, under quantitative factors, we have the potential for fines and penalties, number 2, the cost of remediation, number 3, we have the loss of revenue. So that's all, candidates, for our today's lesson on materiality at the planning stage. In this lesson, we defined the meaning of materiality in the context of governance and compliance audits. We've also outlined the key factors for determining materiality. 1 factor is legal and regulatory impact. Number 2, reputational risk. Number 3, strategic impact. Number 4, control, environment and culture. Number 5, impact on stakeholders. Then we have the quantitative factors. 1 is potential for fines and penalties, the cost of remediation, and loss of revenue. So thank you for attending our today's lesson. God bless you. Bye-bye.
Welcome to Manifested Publishers. My name is Mr. Bernard Mariga. I'll be teaching you advanced management accounting, and today I want us to talk about expected value of perfect information, which is one of the subtopics in planning and decision making. Now, the expected value of perfect information is the value that you are going to get when you obtain perfect information. And the expected value of perfect information can be determined by taking your expected monetary value with perfect information, minus your expected monetary value without perfect information. So basically, expected value of perfect information, this we can simply summarize it as the value you obtain of flawless information. Information. I will start by showing you how you determine the value of perfect information using the payoff table. Using your payoff table. You can also determine the value of perfect information using your decision tree. But let me start by determining the value of perfect information using which method? Using payoff table. So using the payoff table, and we will go to a question on December 2024. 4C. Let's go to question 4C. Should be question 4C. Though we will need to use information on 4B. 4C is saying Lambda Investment Enterprise Limited is contemplating acquiring perfect information from an investment research firm about the viability of the investment opportunities. The investment research firm is willing to provide perfect information about the investment project at a cost of 30 million. Required. Using suitable computations, advise Lambda investment on whether or not to acquire the perfect information from the investment research firm. All right. Now, so what we need to do is we determine our value of perfect information by getting the expected monetary value with perfect information minus the expected monetary value without perfect what? Information. So, as to do that, we need to prepare our a payoff table. So let's have the states of nature, or states of nature, and in this case, your states of nature were what and what? Remember, your states of nature, we've said, they are those events that cannot be controlled by management, and they should have prior probabilities if you're dealing with risk. And this was your economic conditions. This is your economic conditions, which was optimistic with a probability of 0.3, most likely with a probability of 0.4, and pessimistic with a probability of 0.3. Your decision alternative was here, or will be here. You can either invest in corporate, shopping mall, and lastly, residential area. And then we now represent our payoffs. Let's represent our payoffs. 100,000, 70,000, 130,000, shopping mall, 110,000, 90,000, 90,000, residential, 90,000 is your payoff, 120,000 and 70,000. 170 what? 1,000. Now that we have drawn our what? Payoff table, let's determine our expected monetary value with perfect information. Your expected monetary value with perfect information will require that you select the highest payoff for each state of what? Nature. For optimistic, that is your highest payoff. For most likely, that is your highest payoff. For pessimistic, that is your highest payoff. Then these highest payoffs here, you multiply by your probabilities. Why? If you knew under optimistic that the shopping mall is the best decision you could make, there is the most likely chance, or the best decision is to choose what? Shopping mall. If under most likely you knew that the residential results in the most payoffs or the highest payoff, you're going to select what? Residential. In pessimistic, if you had enough information and knew that the corporate is the one with the highest what? Payoff, you would have selected what? Corporate. And that is why we say this expected monetary value with perfect information, which is your maximum payoffs of each what? State of nature. Then you multiply by your who? Probabilities. Remember, expected, you must multiply with your probabilities. And how will that be? You're going to say it is 110,000 with a probability of 0.3 plus 120,000 with a probability of who? 0.4 plus 130,000 with a probability of 0.3 with a probability of 0.3. 110 by 0.3 plus 120 by 0.4 plus 130 by expect how much? That your expected monetary value with perfect information will be how much? Will be 120,000. The next thing I want us to do is to determine your expected monetary value without perfect information. Expected monetary value without perfect information. And the expected monetary value without perfect information is simply your EMV, your maximum expected monetary value. And how did we get your expected monetary value? You simply take your payoffs by the probability. For example, corporate. We have done this previously. Corporate, you're going to take 100,000 by who? By 0.3 plus 70,000 by who? 0.4 plus 130,000 by 0.3. Then shopping mall, 110,000 by 0.3 plus 90,000 by 0.4 plus 90,000 by 0.3. Residential area, 90,000 by 0.3 plus 120,000 by 0.4 plus 70,000 by 0.3 by 0.3. 100 times 0.3 plus 70 times 0.4 plus 130 times 0.3. This should be 97,000. Shopping mall, 110 times 0.3 plus 90 times 0.4 plus 90 times 0.3. That should be 96,000. 90 times 0.3 plus 120 times 0.4 plus 70 times 0.3. 96. But remember, using the expected monetary value approach, you normally select the one with the highest. So this is what? 97. This is your EMV. 97, 96, and 96. So you select the highest. That is the highest. Okay? So therefore, the expected monetary value of perfect information will be your expected monetary value with perfect information of how much? 120,000 minus your expected monetary value without perfect information, which is the highest EMV, which is 97,000. So 120 minus 97, which is how much? 23,000. 23,000. 23 what? 1,000. That is the value that you expect to obtain when you acquire perfect information. When we say acquire perfect information, is where you can hire a company. Then when you hire that company, the value they will give you is worth how much? 23,000. But part C of that question, they are asking advice on whether or not to acquire perfect information. So here what you will do, you will simply now compare the value of perfect information and the cost of acquiring that perfect information. The cost of acquiring perfect information is how much? 30 million, so 30,000. So when you acquire perfect information, it will be worth how much? 23. But how much do you expect to incur for it? 30. So therefore, what will you advise them? You will advise them, do not acquire perfect information. Why? because it is more expensive to acquire than the cost you're going, than the value you're going to obtain, than the value you're going to obtain. So you're going to advise them not to acquire perfect information because it is far much expensive. The cost outweighs the value you obtain. That is how you deal with expected value of perfect information, but using what? Payoff table. Using payoff what? Table. So remember, it is simply the difference between expected monetary value with perfect information minus expected monetary value without perfect information. And you've said the expected monetary value without perfect information, simply you must determine your EMV, expected monetary value, then the maximum, then the maximum. I hope that is clear. I hope that is clear. Simulation is a quantitative method of analyzing uncertainty. Simulation is a quantitative technique of analyzing what? Uncertainty. And with simulation here, there are some basic requirements that you must be provided for. For you to be able to simulate a question, so these are the requirements that you must have in a question. Number one is a probability distribution. You must be given the probability what? Distribution of each variable you want to simulate. Of each variable. That is the first thing you must have. So if you want to simulate sales, they must give you probability distribution of what? Sales. If you want to simulate the quantity, they must give you what? The quantity. Number two, you must also determine your cumulative probabilities. You must determine your cumulative probabilities of each variable. The cumulative probabilities of each variable. Once you have the probability, you can now determine your cumulative probability by adding. The third item you want to have is you're going to get your random number ranges. Your random number who? Ranges. Show you that. Then number 5 is you must also have your who? Random numbers. Random numbers here basically are numbers assigned that show equal chance. They are numbers assigned that show equal chance of occurrence. So random numbers. Once you have determined your random numbers, or once you've been given your random numbers, this case in an exam situation, they will always provide the random numbers. Number 5 is you set up your simulation worksheet. Your simulation worksheet. You must set up your simulation worksheet where you're going to simulate your information. Those are the requirements that are required for us to be able to carry out what? Simulation. So I want us to go to a question. Let's go to December of 2022. December 2022. Question 2A. Question 2A. December of 2022. Question 2A. They are saying, Lengo Limited is considering marketing a new product. The fixed cost of this product will amount to 5 million. There are 3 uncertain factors, namely selling price, variable cost, and annual sales volume. Selling price is for 400, for 50, and 500 with a probability of 0.3, 0.5, and 0.2 respectively. Variable cost is 200, 250, and 300 with a probability of 0.1, 0.6, and 0.3. Your annual sales volume in units is 40,000, 50,000, and 60,000 with a probability of 0.4, 0.5, and 0.1. additional information. Assume that the three factors are statistically independent. The company uses cost, volume, profit analysis to make decisions. The following random numbers are provided. You have your selling price with a random number of 8, 0, 6, 1, 3, 5, 1, 3, 9, and 1. The variable cost, the random numbers are 0, 4, 3, 4, 6, 7, 2, 8, 5, and 9. So let me repeat the variable cost random numbers: 0, 4, 3, 4, 6, 7, 2, 8, 5, and 9. The sales volumes had the following random numbers: 6, 3, 9, 4, 0, 9, 7, 6, 8, and 5. Required. Using CVP analysis criteria, simulate the problem and determine the average what? Profits. Simulate the problem and determine the average what? Profits. Number 1. For us to do this question, we must confirm what we've been given. Have we been given the probability distribution of each variable? Yes, we have been given. So, come here and get the selling price. We have the selling price. You have the shillings, the selling price in shillings: 400, 450, and 500. Your probability, which I denote as P0, is 0.3, 0.5, and 0.2. Let's get our cumulative probability. Let's determine our cumulative probability. This is 0.3. 0.3 plus 0.5 is 0.8, and that is 1.0. The next variable that we have probability is variable cost. So remember, all these uncertain items, you must be given probability. You must be given what? Probability. Your variable cost is 200 with a probability of 0.1, 250 with a probability of 0.6, 300 with a probability of 0.3, 0.3. So that now your cumulative probability is 0.1, 0.7, and that is 1.0. That is for who? For variable costs. The third item that we have our probability distribution is your sales volumes in units. In units. The units are 40,000, 50,000, and what? 60,000. Your probabilities 0.4, 0.5, and 0.1. We need to determine our cumulative probabilities. 0.4, 0.9, and that is 1.0, 1.0. Right. So what we have effectively done is we have the probability distribution. Then using the probability of each variable, we have determined our cumulative probabilities. Our cumulative probabilities. That is in order. All right. Once we have done that, we then need to determine our random number what? Ranges. Our random number ranges. So let me come back here. Computation of random number ranges. So let's again start with selling price. 400, 450, 500. Your probabilities 0.3, 0.5, 0.2. Your cumulative probabilities 0.3, 0.8 and 1.0. Then your random number ranges, I'm just going to write them there. Your random number ranges there. Now your random number ranges will be between 0 and 2. So we normally say when you're determining random number ranges, the ranges should be inclusive. They should be inclusive, such that if you start between 0.2, then the next observation should be between 3 and 7. Then the next one is between 8 and 9. 8 and 9. Okay? That is the selling price. Let me go to what? Variable cost. Some of these items I am repeating, which is also in what? Shillings, probability, cumulative probability, and random number what? Ranges. $200, $250, and $300. Probability is 0.1, 0.6, 0.3, 0.1, 0.7, and 1.0. The random number ranges now will be between 0 and 0. Why? Because we've said it must be exclusive. It must be inclusive. It must be inclusive. Then 1 to 6, 7 to 9 must be inclusive. That is your variable cost. Let's now finalize determining the random number for sales volume. Cumulative probabilities 40,000, 50,000, and 60,000, 0.4, 0.5, 0.1, 0.9, and 1.0. Then we must determine our random number what? Ranges. So this is 0 to 3, 4 to 8, 9 to just 9. Summer 9 or 9 to 9, no problem. 9 to 9 there. So remember what guides us when you're getting the random number ranges. Number one is the decimal point. So if we had two decimal points here, for example 0.30, I would have written my random number ranges in tens, not ones. Here they are in ones because the decimal place is in one place. So if they are more than what? One decimal place, if it is more than one decimal place, I will also have the random number more than once. More than once. So let me adjust that. Right. That is wonderful. Let's now prepare our simulation worksheet. Our simulation worksheet. Okay. We have already been provided the random numbers, so that we have. So we want now to prepare our simulation worksheet. When you're preparing this simulation worksheet of CVP, you're going to prepare it according to what is being asked in the question. And here they are telling us required, simulate the problem and determine the average what? Profits. How do we get your profits? You say it is P minus V by the units minus your who? Fixed costs. Minus your fixed cost. So this is how your simulation worksheet should look like here. Okay. So the first item should be your selling price. But because selling price, you've been given random numbers and the probabilities, so because it was uncertain, we will come here and write the random numbers and your selling price P. There. The variable cost, we did also being provided the variable cost, their probabilities and random numbers. So again, we introduce random numbers for variable cost and who and the variable cost there. Then your random number for the units you want to do what? To sell, for the units Q. For your units. Then we know, or we can first determine our contribution margin. Let's first determine our contribution margin CM, which is given by P minus V. So this is not fully a requirement, but let's just determine it. If you're able to just compute directly, well and good, but let me show you that so that we simplify our work and we look more organized. Okay? So that is P minus V, contribution margin. Let's get the random numbers for your units, for your units. Then we get our total contribution and your fixed costs. And then lastly, your who? Profit. Lastly, your profit. We can even try squeezing this. Left so much spacing. So we can readjust this. I'm just rewriting this so that it is better off for you. It is better off for the students to see. And fixed cost, and then your profit, and then your profit. All right, that is how a simulation worksheet of CVP should look like. The first random number of selling price is 8, and with the selling price of 8, or rather with a random number of 8, your selling price is between 8 and 9. The random number, you normally read it according to the random numbers. So you go to your selling price, and where you have a random number of 8 and 9 is at a selling price of how much? 500. So here you're going to write what? 500. Then variable costs random number is 0. Your variable cost with the random number, when your random numbers are 0, your variable cost is 200. Then your contribution margin will be 300. Why? 500 minus 200. The next random number of sales volume is 6. And with the sales volume of 6, of random number 6, your units should be 50,000. Then to determine our total contribution, you're going to take your contribution margin by your units. So I believe that is 150 or 15. 1, 2, 3, 4, 5. Your fixed cost was 5 million. Fixed cost was 5 million. Then you get your what? Profit. Then you get your what? Profit. Is that a profit of 10 million? That is a profit of what? 10 million, All right. The next random number is 0. So allow me to just write these, all of them together. 0, 4, and 3. With the price of 400. Why? Because with the selling price of 450 actually, because your random number is between 3 and 7, So 450. Let me see. Yeah. Your random number is 0. So your selling price is 400. Don't get this confused here. 400. With a random number of 4, the variable cost is 250. So your contribution margin is 150. With a random number of 3, you're selling how many units? 40,000. Okay, we'll come back to the contribution. Then 6, 3, 9, 1, 4, 4. Just highlighting the random numbers now. 3, 6, 0, 5, 7, 9, 1, 2, 7, 3, 8, 6, 9, 5, 8, 1, 9, 5. All right. The random number of 6, your selling price is 450. 1 is 400. 3 is 450. 5 is 450. 1 is 400. 3 is 450. 9 is 500. 1 is 400. Variable cost of 3 is 250. 4, 250. 6, 250. 7, 300. 250. 8 is 300. 250. 300. So remember, what is guiding us is our ranges. The quantity, 9 is 60,000. 4 is 50,000. 0 must be 40,000. 60,000. 7 is 50,000. 6 is 50,000. 50,000. And lastly 50,000. This is 200. 150. 200. 150. 150. 150. 250. 100. Then what do we do now? We get our total contribution. 150 by 40 million. 40,000. That is 6 million. Your fixed cost is 5 million. 250. 200. 200 by 60,000. This is 12 million. That is still 5 million. So that should be 7 million. 7.5 million. 5 million. 2.5 million. This is 8 million. 5 million. If fixed cost is not changing. 3 million. 9 million. 5 million. 4 million. 7.5. 5 million. 2.5. 7.5 million. 5 million. 2.5. So remember, your total contribution is contribution margin by the units. Please don't forget. That is why 300 by 50 is that. what have you. 250 by 50,000 must be 12.5, and is 5 million. 7.5, this is 5 million. Then we get our profits. Let's get our profits. We simply add these profits. Plus 2.5 plus 2.5 plus 7.5. Is that 40 million? So therefore your average profit, remember in the question they are asking for average what? Profit. Going to take 40 million, divide by the number of times you've simulated. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 4 million is your average profit. 4 million is your average profit. And that's how we simulate what? CVP. That is how we simulate CVP. All right, I hope that has been properly understood, such that if it comes to question, you will be able to do what? To handle it. So the remaining items is sensitivity, statistical analysis, probability tree diagram, and continuous or normal distribution. Continuous or normal distribution. All right. Now, we're going to cover these next items during the next what? Session. During the next session. So from me, I wish you the very best and see you in the next session. Goodbye.
Greetings and welcome all to the Manifested eLearning platform. Today we are going to begin on a new topic. The subject is finance for decision making. Today's topic, budgeting and budgetary control. This is a new topic which has 6 subtopics, which are 1. Nature and purpose of budgets. 2. Limitations of budgets. 3. Preparation of budgets. 4. Purpose of budgetary control. 5. Distinction between budgeting and budgetary control in the private and public sectors. Then lastly, cost volume profit analysis. These are 6 subtopics under the topic budgeting and budgetary control. In this lesson, we are going to focus on the first subtopic, which is nature and purpose of budgets. Nature and purpose of budgets. But before we get into the nature and purpose of budgets, it's important for all of us to understand the meaning. What is the meaning of budgeting and budgetary control? Those are 2 things: budgeting and budgetary control. So these are 2 concepts, budgeting and budgetary control, which are interconnected, and they form the core of financial planning and management within any organization. Any organization must deal with these 2 issues, budgeting and budgetary control. We begin by defining budgeting. What is budgeting? Now, budgeting is the process of creating a detailed, quantified plan that is expressed in financial terms for a specific period of time. And in essence, it is the activity of preparing the budget document. So a budget is a plan. And we know a plan is a predetermined course of action. Every organization must have a plan for its financial planning. Okay, it must have a predetermined course of action on how it's going to get finances, how it's going to spend finances, and so on. So budgeting is a process of preparing that financial plan. It involves forecasting the expected revenues on one hand and estimating the required expenses for various activities, various departments, and also projects to achieve organizational goals. Every organization has goals, and these goals require finances. And these finances we all know finances form part of resources, and generally resources are scarce. So it's important to have a plan on where the revenues will be acquired, from where they'll be acquired, and how they are going to be spent. In other words, budgeting is a roadmap or a blueprint for future projects to achieve organizational goals. It is a blueprint, okay? A budget is a blueprint for future action, which translates strategic objectives into measurable financial targets. So the output of this process, the output of this financial planning is what we are referring to a budget. A budget is the output, which is the final quantitative statement of the plan. So that's the meaning of budgeting. Now, budgetary control, on the other hand, is a system of management control. So, budgeting, we see there is the word control there. Budgetary control. Budgetary control is a system of management control where budgets are used as a means of planning and, more importantly, regulating and coordinating all aspects of the business. So budgetary control is a continuous process of ensuring the organization's activities align with the financial plan. They align with the budget. And it is, just as I've said, a continuous or an ongoing monitoring and adjustment process that happens after the budget is created. So creating the budget is one thing, but there has to be that continuous process where the organization is kept on track, where the organization does not veer off from the budget, does not veer off from the plan. You understand? And the budgetary control involves the continuous comparison of the actual performance with the budgeted figures. For example, we may have a sales budget or a purchasing budget or cash budget, a plan. Okay, cash budget, which the organization intends to adhere to or to maintain during a given financial period. So this budget, there has to be a continuous process where the actual performance, the actual expenses are compared with the plan so that there are no variances. But we know in practice, variances are inevitable. You may have budgeted to purchase materials or to spend certain amount, but there are some events that may occur beyond the control of the organization, which may result into variations. So budgetary control may include variance analysis also, which means identifying and also measuring and explaining the difference between the actual and the budgeted results. And budgetary control culminates then into corrective actions or measures to bring performance back on track. And it may necessitate revising of the budget to reflect new realities. So budgetary control, we can then say, establishes what we call accountability by assigning responsibility for meeting the financial targets to specific managers or departments, or what we call responsibility accounting. So that's the meaning, candidates, of the two concepts, a budget or budgeting and budgetary control. So budgeting is done at the planning phase, and the budgetary control takes effect at the control phase. So one is a planning document, another one is a document for, is a process of controlling. So as I said, the two concepts are interconnected and form the core of financial planning. You cannot have budgetary control without the budget in the first place. And having a budget without budgetary control, then the objectives of budgeting may not be met. The organization may not meet its financial. So that's the meaning. Let's now get to the first topic, which is a subtopic, which is the nature and purpose of budgets. Nature and purpose of budgets. And purpose of budgets. Let's begin with the nature. Nature. What is the nature of budgets? We've just defined what a budget is. We've said essentially it is a detailed financial plan that estimates income and expenditure for a given specific period of time. It could be a week, it could be a month, the time could be a year, it could be 2 months, depends. It is a detailed financial plan that outlines the estimated income and expenditures for a given period of time, often 1 year, which may also be broken down into shorter periods like monthly, quarterly, and so on. So in defining the nature of budgets, the first point that helps us understand the nature of budgets is that budgets are forward-looking. Budgets are forward-looking. Budgets are based on, that is to mean that budgets are based on projections. Projections. Budgets are based on projections. Budgets are based on projections and estimates for future periods, which makes them a tool for planning rather than just recording historical data. It is forward-looking. A budget is a forward-looking document. That is one point to help us understand the nature of budgets. Forward-looking. It is based on projections. What will be spent, what will be incurred, or what will be raised in future. Forward, future. Budgets are futuristic. Point number 2 is systematic, or let me say quantitative. Let me begin with quantitative. Quantitative as opposed to qualitative. Budgets express plans in measurable rather than just numerical terms. They express plans in measurable numerical terms, typically in terms of money. But they also may include non-financial metrics like units of production, hours, and so on. But they all are quantitative. A budget has to be quantified in terms of money. It may be quantified in terms of units, what the organization plans to produce in future. That is quantitative. So it could be in form of money, which is quantitative. It could be in form of units, hours, and so on. 3, systematic framework. What do I mean by systematic framework? Now, the process of creating budgets provides a structured approach for allocating resources towards achieving specific objectives. Provide a structured approach. There is a systematic approach, a structured approach. Budgets, for you to come up with a budget, you need to have a systematic approach, a structured approach. If you are talking about cash budget, there is a structured approach, it's a structured framework for preparation of the cash budget. If it is a sales budget, then there is a structured framework which must be adhered to when preparing such a budget. Thematic or structured approach. Number 4, budgets are dynamic. dynamic. They are not static. They are dynamic. Because while budget provides a plan, while it provides a plan, the plan should be flexible enough to be reviewed and adjusted to account for unexpected events or unexpected changes in the business environment. You understand? Earlier I talked about controlling. Budgets are dynamic because a company may have, for instance, projected to produce 10,000 units within a given year. But due to changes in the environment, the company maybe has new customers, necessitating that more units be produced. The company may get resources to increase the production capacity. And given that the company had a budget of producing 10,000 units, it may be subject to change because of the new the changes in the environment. And that's where budgeting control comes in. So that in case of any changes, variance analysis is conducted and corrective actions are taken in case there are changes, in case the budget is changing. So budgets are dynamic. Okay. Number 5, budgets are integral to planning. Budgets are integral to the planning, and let me just add and control. Budgets are integral to planning and control cycle. Budgets serve as both the target and also the benchmark against which actual performance is measured. So these are 5 points to explain the nature of budgets. Then, what's the purpose of budgets? Purpose. What is the need? Is there a need to have budgets? What are the key objectives or purposes of budgeting in an organization? There are very many reasons why budgeting is important. And one such reason is just planning. For planning purpose. Planning. How are budgets important for planning? Now, one is formalizing plans. Okay, for the purposes of formalizing. What does that mean? Formalizing plans. Now, budgets translate the organization's strategic goals and objectives into concrete, measurable plan of action. That's what we mean by formalizing plans. It may also be important in terms of forecasting. Still under planning, we have forecasting. They force management to look ahead, to anticipate future opportunities and problems, and plan how to address them. Budgets, for example, may help the organization to anticipate cash shortages, then take corrective measures before the shortages occur. That's point number 1 on planning. Point number 2 on purpose. Purpose of budget is that budgets may be used for resource allocation. Resource allocation. Budgets ensure that scarce resources like cash, like labor and materials are directed to the highest priority areas, to the highest initiatives, and that align with the organization's strategic goals. So that means efficient allocation. Budgets can help the company to efficiently allocate resources. Efficient allocation of resources can be made possible due to budgeting. Then there is also the aspect of prioritization. Prioritization. Budgets necessitate choices, helping to determine which projects or departments receive funding and which do not. Prioritization. The third purpose of budget. Candidates, we are now discussing purposes of budgets. The first purpose is planning. The second purpose is resource allocation. The third point is coordination and communication. Coordination and communication. Coordination and communication. Budgets may be very useful in what we call interdepartmental coordination. departmental coordination. Interdepartmental coordination. The budgeting process requires different departments to communicate and align their plans, which ensures that all parts of the organization work harmoniously towards common goals. Because you cannot draft a budget, so for example, a sales budget, without the input of the sales department and the input of the finance department and the input of the purchasing department. All these departments are forced under budgeting to work in harmony in order to achieve organizational goals. Interdepartmental coordination. There are also goals related to communication. Communication goals. Communication goals. A final budget clearly communicates the organization's financial targets and operational priorities to all levels of management and employees. That's the third purpose. Now, the fourth purpose of budgeting is that budgets can be used as a control tool or performance evaluation. Control and performance evaluation. That may sound self-explanatory. You may use budgets as a benchmark for control. One benchmark for control. Control means measuring actual performance vis-a-vis the budget. Budgets act as a standard against which actual financial results can be compared. 2. Variance analysis. Variance analysis. By comparing actual results to budgeted figures, the management can identify variances, then investigate the causes of the variances, and then take corrective action through what we call management by exception. Then there is performance evaluation. Performance evaluation. Budgets provide a basis for evaluating the performance of departments, the performance of managers, and also the organization as a whole. Another purpose, number 5, is motivation. 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 That goal setting can be a motivation. When managers and employees are involved in the budgeting process, the resulting targets can serve as a motivator to achieve the set financial and operational goals. Then we can also talk of accountability. Accountability. Budgets assign responsibility for achieving specific revenue or cost targets, which then promotes financial discipline. 6, we have decision. Another purpose is related to decision making. Now, the data and projections within a budget provide a clear financial framework to support informed decisions regarding investment, regarding pricing, regarding expansion, and also regarding cost-cutting measures. So these are 6 reasons why budgets are important. And that marks the end of our today's lesson on the nature and purpose of budgets. We've outlined 5 points to explain the nature of budgets. Number 1, we've said budgets are forward-looking. Number 2, they are quantitative. Number 3, they require a structured approach or systematic approach. Budgets are dynamic. Budgets are integral to planning and control cycle. Then we have 6 reasons why budgets are important, the objectives of budgets, the purpose of the budgets. Number 1 is for planning purpose. Budgets may also be used as a tool for allocating resources efficiently. Budgets can be used to coordinate different departments. They can also be used to communicate, right? Communication. Number 4, budgets can be used as control and evaluation tool. Number 5, budgets can motivate the management and the staff. Then lastly, budgets are useful for the purpose of making decisions. That's the end of the lesson. We meet in our next session. We'll continue to share knowledge in finance for decision making. We are on the topic budgeting and budgetary control. Bye-bye.
(2022) question 3B. Question 3B. It is also important to highlight what this means before we forget. That is your budgeted quantity. That is your actual quantity. I think all the other items we have them. Now this standard quantity in standard mix basically means it is your budgeted quantity there. So let's have that as your budgeted quantity. Your budgeted what? Quantity. Right. April 2022 question 3B. April 2022 question 3B is the question I want us to look at today. The saying, Dominion Beverages Limited makes and sells two beverage products branded Bingo and Boost. The budgeted sales profits for the year 2021 are as follows. You have your product, your sales in units, and your revenue, your cost, and your profit. Actual sales were as follows for Bingo and Boost: to 80 units with a profit of 5.3, 630 units with a profit of 2.8. The company's management is able to control the relative sales of each product through the allocation of sales effort, advertising and sales promotion expenses required. Calculate and interpret the following. Number 1, sales margin, price variance, sales margin volume variance, sales margin mix variance, your sales margin quantity variance, and your sales margin total variance. Now your total variance simply is the summation. Just indicate that. It is simply your sales price variance plus your sales volume variance. Simply the total of that. Right. Let me have this question here. You will have your products, your sales in units, that is your sales quantity in units. You have the revenue in shillings, your costs in shillings, you will have your profit in total in what? Shillings. You have two products, Bingo and Boost. How many units did you sell? 400 and 300. That means in total you sold 700. This is your budgeted. Your revenue was 8,000, 12,000. So your total revenue is 20,000. Cost is 6,000. 11,100. 17,100. Your profit or your budgeted profit was 2,000, that is 900. So that your total profit is how much? Total budgeted profit is 2,900. Then your actual sales. Bingo was 280 units with a profit of who? With a profit of 5.3 per unit. Boost 630 units with a profit of who? $2.8 per unit. 2.8 per who? Per unit. We can start with our first variance, sales margin price variance, the first part of that question. Your sales margin price variance, you're going to say what? It is your standard what? Your actual quantity sold, your standard selling price per unit minus your actual selling price per unit. In this particular question, we had two products, the first one being who? Bingo, and the other product being who? Boosts, being Boost. Your actual quantity sold was how much? 280 to bracket. This SP here, since it is what? For margin, they simply wanted you to realize that you're supposed to use what? A profit. You're supposed to use your what? Profit. So let's get your profit per unit. Profit per who? Per unit. You're going to take 2,000 divide by who? By 400. 900 divide by who? 300. That is 5. That is 3. So your standard profit is 5. Your actual profit here is what? 5.3. 5.3. For Boost, 630. 3 minus who? 2.8. Now let me clarify and say, in this particular question, the actual values here, we've not been given the revenues. So there is no way we can determine our what? Our selling prices here. We've only been given what? Profits. So that is what we're going to use. But in case we had been given what? The revenues here of the actual sales that were made, we would have determined this price variance by taking your actual quantity sold, your selling price, your standard selling price minus your actual selling price. But you're saying because we don't have our what? Selling prices here, we only have our what? Profit for actual sales. There is no way we can use our what? Revenue, our profit here, or rather there is no way we can use our selling prices here. Okay. Now, so let's analyze this variance. 280 to bracket 5 minus 5.3. This is 84. Times 630. that is 126. Then we need to analyze whether it is favorable or adverse. This is favorable. Why? It is you selling, or this is a profit you're earning. In fact, this is a profit. You had budgeted to earn a profit of 5. You have ended up with a profit of 5.3. Favorable. This will be adverse. Why? You had budgeted to earn a profit of 3. You have ended up with a profit of 2.8. That is not good for the organization. Your profits have reduced. Therefore, that will be 42 what? Adverse. 42 adverse. Okay. The next variance that they want us to determine, number 2, is your sales margin volume variance. Sales margin volume variance. How did we say you get that? You're going to take your standard profit, budgeted quantity sold minus actual quantity done what? Sold, minus actual quantity sold. Okay. You have 2 products, Bingo and who? Boost. Your standard profit was 5 and this was 3. That is your standard profit. Your budgeted quantity sold was 400. Compare this with an actual quantity sold of how much? 280. Budgeted quantity sold was 300. Compared with an actual quantity sold of how much? 600 and what? 30. 630. So 5, 400 minus 280. This is 600. 300 minus 630. Let's see whether we have a whether it is favorable or adverse. It is you selling, so that will be adverse because you've reduced your volume of sales from 400 to 280. This, you have increased your volume of sales, so that should be what? That should be favorable. That should be favorable. Which you're going to say is what? Favorable. That is what? Favorable. So your sales margin total variance, we will look at it, but it is basically the product of these two. We'll come to it later on. Let's go to the third part. The third part where they're asking for what? They are asking for your sales margin mix variance. Sales margin mix variance, which is your standard profit. Your actual quantity in standard who? Mix minus your actual quantity in actual mix, or simply your actual quantity, or simply your actual quantity. Okay. We need to identify our actual quantity sold is here, but you need to identify your actual quantity in standard what? Mix. So let me write this here. Let me write it here. actual quantity in standard what? Mix. Nine, 10, eh? Now, your actual quantity in standard mix is simply telling or simply requires that you share this actual quantity using the ratio of your standard mix, and your standard mix is here. Okay, so for bingo, you're going to take 400 over 700 times who? 900 and who? 10. 300 over 700 times who? 900 and who? 10 times 910. 520 is your actual quantity in standard mix. 390. So that you'll have sold how much? 910. So bingo, your standard profit per unit was 5 and 3. For boost, your actual quantity in standard mix 520, and this is how much? 390. Your actual quantity in actual mix is simply the actual quantity you sold, 280 and 630 and 600 and what? 30. $1,200. $720. We then see whether it is favorable or adverse. So actual, this is quantities, so this should be adverse. This should be favorable. That should be favorable. Okay. The other variance they are asking for, that is your mix variance. Part 4, they are asking for your what? Your sales margin quantity variance. Your sales margin quantity variance. Sales margin quantity variance, which will be your standard profit. Your budgeted quantity, standard what? Mix minus actual quantity in standard mix. Standard what? Mix, eh? Let's start with bingo. Boost 5, 3. Your budgeted quantity, basically it's this budgeted quantity you sold or you had budgeted to sell, okay, in standard mix. So 400, 300. Your actual quantity in standard mix, we've calculated it here, 520 and 390. $520 and what? 390. 400 minus 520, 600, 300 minus 390, 270. Favorable. 870, which you're going to say is what? Favorable. Now that we have calculated our sales margin quantity variance and our sales margin volume what? Variance. Let's confirm that when you take your volume, your mix variance plus your sales quantity variance, it will give you your what? Your sales margin volume variance. So we say your sales margin mix variance plus your sales margin quantity variance will give you your sales margin volume variance. Your margin mix variance is 480 adverse plus your sales margin quantity variance of 870 favorable will give you a volume variance of how much? 390 favorable. 390 favorable. Right. So those two answers should give the same. Yeah? So that means we are correct. We have indeed proved that. Number 5 was your total sales variance. Total sales variance, which is the summation of your price variance plus your volume what? Variance. That's your volume variance. Your price variance your price variance is your 42 adverse plus volume variance of 392 favorable. So therefore this should give you 348, which is what? Favorable. 348, which is favorable, right? Those are variances of sales that we have successfully done what? Tackled. Remember, I've told you under normal circumstances, absorption you use profit to get your what? Your volume. And marginal you use your contribution. And you know, remember, contribution is simply the difference between selling price per unit and your total variable cost. All right. This April 2022 question 3B is an exemption to that. Why? Because you have what? You have profit. You don't have the selling prices for to calculate your sales price variance. Right. And with that being said and done, in the next lesson, we will talk about advanced variances of fixed overheads. So, from my part, goodbye and see you in the next session. Welcome to Manifested Publishers. My names are Mr. Mariga, and I'll be teaching you advanced management accounting. So today we are going to continue with the topic we had started previously or in previous sessions on planning and decision making and planning and decision making, where we had talked about cost volume profit analysis under conditions of uncertainty. Specific items we discussed during the previous sessions is number one is cost volume profit uncertainty model using expected value approach, using simulation approach. So today we will discuss using sensitivity analysis and maybe using statistical analysis. But let's start using sensitivity analysis. So C is sensitivity analysis. Now, sensitivity analysis here is basically where you want to measure or you want to identify or to determine the percentage change in factors affecting profits as a reason of changes in what? In profit. Let me explain that. You want to determine how sensitive one of the profit is as a result of changes in what? One of the factors affecting what? Profit. And we can have an illustration given your selling price per unit is 200, your variable cost per unit is 50, your fixed cost in total is 200,000, and your current sales is how much? 2,000 units. Then required, can say required, compute the percentage change in each input, variable, in each input variable, which will cause profit to drop to what? To zero. So determine the percentage change of each variable which will cause the profit to drop to what? To zero. We can start by determining that and realizing that your profit, which we denoted as P, as pi rather, is P minus V. You multiply by your units minus your what? Fixed costs. Minus your fixed cost. So you want to analyze what change will the selling price change by for the profit to be zero? What percentage change will the variable cost change by to give you a profit of zero? The fixed cost and also the units. Let's start with A, percentage change in what? In P, in selling price P per unit. Remember, P means your selling price per unit. Your current profit is going to be zero. You have to determine a new selling price. Your variable cost is 50. Your units sold are not going to change, will be how much? 2,000 units minus a fixed cost of 200,000. 100,000 minus a fixed cost of 200 what? 1,000. So this will be 200,000 is equals to 2,000p minus 10. That is what? That will be your what? Your equation. That will be your equation. What we've done, we've simply taken 200 to the other side, then opened this bracket by taking 2,000 by p, that is 2,000p, then 50 by 2,000, that should be 100,000. Then you're going to say 300,000 is equals to 2,000p. So that means your new selling price for it to result in a profit of how much? 0, means your selling price will be what? 150. But remember, we want our percentage change. So you're going to take the current or your new selling price, which is how much? 150. You subtract your original selling price of 200, divide by what? Original selling price of 200. Then you multiply by who? 100%. You multiply by 100%. So it basically means that for your profit to fall to 0, the selling price will need to reduce by what percent? 25%, if all the other factors are not being done what? Affected. That is a percentage change in what? Selling price. Let us also do the same for variable cost. Percentage change in variable who? Cost. Again, you want your profit to be 0. All the other factors apart from what? Variable cost will be the same. Your original selling price is 200. You want a new variable cost. How many units are you selling? You're selling 2,000. And your fixed cost is still originally how much? 200,000. 200,000 is equals to 2,000 by 200. That will be 400,000 is equals to 200,000 or 2,000 of what? V. So 200,000, if you work it out, is equals to what? 2,000. So your variable costs will be how much? 100. So for your selling, for your variable cost to give you a profit of 0, it will need to be set at what? 100. So let's determine our percentage what? Change. Your percentage change, which will be your original, or rather your new 100 minus the original, which was how much? 50. Then divide by the original, then times what? 100 times 100. So therefore, that is 50%. 50%, which basically means that your variable cost will have to do what? To increase by 50% for the cost to do what? For the cost to have an impact of making the profit to be what? 0, of making the profit to be 0. That is your variable cost. Then the other factor that we want to analyze, say percentage change in what? Units. So percentage change in what? Units. So we want to identify what change will result in profit being what? 0. What change in units will result in profit being 0. So you will say 0 is equal to, your selling price is 200, your variable cost is 50. The units, you don't know, but you know your fixed cost is how much? 200,000. So therefore, your units will be 200,000 divided by who? 150. Divide by 150. 33.33 units. So for the company to gain a profit of 0, which is where your revenue and your cost are equal, you have to sell how many units? 1333.33. 1333.33. Let's now identify the percentage what? Change. Your new units minus your original units, divide by your original units, times 100%, times 100%. So we want to take the percentage change. Percent. So it basically means what? That your units will have to fall by 33.33% for the profit to be what? 0. Let's analyze your fixed costs. Percentage change in fixed costs. Your percentage change in fixed costs. Again, you want a profit of 0. Your selling price will be your as original 200. A variable cost of 50. Your units are 2000, but you know you don't have your what? Fixed cost. So therefore, your fixed cost will be what? 150 by what? 2000. When you work that one out, that will give you 300 what? 1,000. What we've simply done, we've taken this fixed cost to the other side. Then open that bracket. Alright, so your percentage change in fixed costs will be your new fixed costs minus your original fixed cost, divide by your original fixed costs, times 100. So it basically means that your fixed cost will have to do what? To change by 50%, or it has to increase by 50% for the selling price or for the profit to be equal to what? To 0. To be equal to 0. That is what we refer to as sensitivity analysis. Simply analyzing the percentage change in one variable as a result of another variable. All right. Sensitivity analysis is that. Let's go to the next method known as statistical analysis. The next method is what we are referring to as statistical analysis. Statistical analysis. Now, statistical analysis here simply involves using statistical measures to determine how cost volume profit is reacting, or how a product is reacting. And the following are the common measures used. The measures of statistics. The first measure of statistical analysis that we could use to analyze cost volume profit under conditions of uncertainty is what we refer to as expected value. Your expected value, which we have already even covered here, and your expected value, we said, how do you determine your expected value? You simply take x, you multiply by probability. It could also be given by the summation of x divided by n. So for the second formula to be used, you only use it when you don't have what? Probability. The second measure of statistical analysis of CVP under conditions of uncertainty is what we refer to as standard deviation. Standard deviation, which you denote as that. So the standard deviation here is given by the summation of probability x minus the expected value. You do what? you square x minus the expected value, you square. In case you don't have probability, this is the formula you use, n minus 1, where n simply represents the number of observations. N is the number of what? Observations. The third statistical measure is coefficient of variation. Which you simply denote as CV. So CV, you simply say it is your standard deviation divided by your expected value. Your standard deviation divided by your expected value. Your standard deviation by your expected value. We can have an illustration. To guide us on statistical measures of CVP. You can have an illustration that we will use to do this question and to illustrate statistical measures of CVP. And the illustration will read as follows. It will read as follows. A company is considering mutually exclusive products. And A and B. The following information has been provided. We can start with product A. Product A, you'll have your probability and your profit in shillings. Your probability and your profit 0.1, 0.7 and 0.2. 10,000, 20,000 and 30,000. Product B, have your probability and your profit in shillings. .4, 0.5, 0.1, 10,000, 20,000 and 30,000. Then the requirement here, using statistical measures of CVP, advise the management of a company, on the product to produce, So they want us to analyze using the statistical measures which of our two products, whether A and B, we should do what? Produce. We should produce. We can start by getting your expected value. And we know that is given by your probability times who? Times the profit, or the variable. In this case, the variable is your profit. So 0.1 by 10,000, 0.7 by 20,000, 0.2 by 30,000. You expected profit for B, for product B, 0.4 by 10,000, 0.5 by 20,000, 0.1 by 30,000. We need to determine this. This is 1,000. That is 14,000. And that is 6,000. So that the expected value there will be what? 21,000. That must be 4,000, 10,000, 3,000. So that is 17,000. So using the expected value, product A, product B, and your advice. Product A, product B, and your who? Your advice. So using the expected value approach, product A had an expected value of 21. Product B had an expected profit of 17. So the product you want to produce in this case will be the one with the highest expected profit, which will be product A. So you advise them to produce product what? A. Let's determine our standard deviation. So we introduce your probability. X minus X bar, you do what? You square. 0.1, 10,000. Your expected is 21,000. Then what do? We square. 0.7, 20,000. Minus unexpected of 21,000. We do what? We square. 0.2, 30,000. Minus unexpected of 21 squared. Then what do? We square. The same case is true here. That is how you get your deviation. Your probability is 0.4. 10,000 minus unexpected of 17,000. Square. 0.5. 20,000 minus unexpected of 17,000. But remember to do what? To square. 0.1. 30,000 minus unexpected of who? 17,000. And what do? You square. You square that. And once you're done squaring, you must get your who? Total. So let's do this together. 10,000 minus 21,000 squared plus 0.7, 20,000 minus 21,000. What do? You square plus 0.2, 30,000 minus 21,000 squared. But remember, you must confirm your answer so that you see whether it is what? Accurate. This, I believe, should be 29 what? Million. 29 million. Then let's talk about the other products. B. Let's determine this the variation there of product B. We're still comparing the actual minus your expected, then you multiply by probability of each. That is 41,000. But again, we've said, please make sure you confirm. Please make sure you confirm for accuracy purposes so that you don't make a mistake. Please always confirm your answer so that you don't make a what? A mistake. All right. Now, the standard deviation. Standard deviation. So there, what do you do? So the standard deviation of 29 million. And the standard deviation of who? Of 41 million. Or the rather square root of 41 million. This I can see is 6403.12. This is 5385.16. So you're going to tell them to use product what? A. Why? Because it is the one with the least standard deviation. Then your coefficient of variation, you're going to take 5385.16 divide by 21,000. 0.256, then 6403.12 divide by who? 17,000. 0.377. And here you look at the one with the least coefficient of variation, which in this case you're going to say it is product what? A. Product A. Why product A? One of the measures of risk is coefficient of variation. One of the measures of risk is coefficient of variation. So you look at the one with what? With the lowest risk. With the lowest risk. And those are what we refer to as statistical measures or statistical analysis of CVP under conditions of uncertainty, under conditions of uncertainty. So this, we are done with it. Remember, you're going one at a time. One at a time. Let's now talk about number E, or the fifth method of dealing with CVP where you are uncertain, which is probability tree diagram. Probability tree diagram. So you will allow me to do away with this, your probability tree diagram. Your probability tree diagram, is where you simply draw a tree diagram, almost similar to when you're dealing with probability trees. From your mathematics, you must have done probabilities. So we'll be drawing a similar tree. And for us to be able to draw that or to illustrate that, there are certain items we must be given. One of the items that you must be given is your probability. You must be given your who? Probability. And you must be given your variables. You must be given your probabilities and your what? Variables. Your variables here may be labor cost, maybe material cost, maybe direct expenses, variable overheads, maybe the variable cost, maybe the fixed cost, maybe the units to be produced and sold. But they must give you some variable that you're going to represent in your tree diagram so that it can help you to get a decision. For example, if they're asking you to draw a tree diagram to determine your contribution, you know your contribution is the difference between your selling price and your variable cost. So one of the items that they must provide is your selling price. The other item they must provide is your variable cost. They must also provide your what? Quantity sold. If they ask you to represent or to determine profit using probability distribution again, they will give you selling price that they must provide and the probabilities. They must also give you what? Variable cost with the probabilities, the units sold, the fixed cost. So we're saying when you're dealing with a probability tree diagram, there is some certain information you must be done what? Given that is uncertain, and that is why you're going to be drawing a what? A tree diagram. And I want us to look at an illustration on the same, on a tree diagram. And the question I want us to talk about specifically is on April 2024. Let's go to April 2024. April 2024. The question we want to tackle is question 2A. And the company name is what? Joe Mwinzi. That is the name of that company. Joe Mwinzi, the management accountant of Vera Enterprises that makes and sells products Alloy, has made the following estimates. You have your sales, you have three conditions, which is the worst, the most likely, and the best. You have your probability of the sales. You also have your variable cost under the conditions that are worst, most likely, and best. You have your costs or variable cost per unit under those conditions. And you also have the probability of variable cost under those conditions. Additional information. The selling price of Alloy product is 1,000 per unit. Fixed cost attributable to Alloy product is 24 million. Vera Enterprises intends to achieve a target profit of 6 million. Using a probability tree, compute the expected profit of Vera Enterprises. Number 2, compute the probability that Vera Enterprises will fail to break even. Number 3, determine the probability that Vera Enterprises will not achieve the target profit. The target profit. So they're telling us to determine your expected profit using your tree what? Diagram. Remember, from the previous working, we know how do you get expected values? You simply take your variable, you multiply by your what? Probability. So even in this particular circumstance, to get our expected profit, we will take our profit, you multiply by your what? Probability. But you know, how do you determine your profit, class? Your profit, we've talked about it so many times. It is determined by your selling price minus variable cost. You multiply by your units, and then you subtract your what? Fixed cost. You subtract your fixed cost. They are telling us that the selling price is 100. Your variable cost has been provided, and various costs have been provided with various what? Probabilities. So it basically means you are uncertain of the true cost of the variable cost. The units to be sold after production, you have been given under various conditions and their probabilities. And so this is how you're going to draw this tree diagram. This is how you're going to draw this tree diagram. Let's start by determining the units. There, there, and there. Your units, you have 45,000 units. with a probability of 0.3, and those are the worst conditions. That is worst condition. The next condition is when it is most likely. Most likely. And most likely, your probability is 0.6. Then you have the best condition. The best condition, you have a probability of 0.1. Of 0.1. 0.1. How many units are these of most likely? 50,000. And best conditions was how much? 55,000 units. 55,000 what? Units. We have represented the units to be produced and sold. So these are your who? Units. These are your units. The other uncertain item that we don't know about is your variable costs. Your variable what? Costs. And your variable cost, we will have it in 3 market conditions. 3 market conditions. Let's draw it nicely. 3 market conditions. The first market condition is 0.3, which is what? The worst. So let me write this here, the worst. The worst condition with a probability of 0.3, and your cost is 350. Most likely is the next market condition. With a price with a probability of 0.5, but a cost of how much? 400. You have the best condition with a probability of 0.1 with a price of how much? 550. You repeat this. Worst, your probability is 0.3. Most likely, your probability is 0.55. The best condition, your probability is 0.15. 0.15. Then we also need to analyze what? Worst, 0.3. Most likely, 0.55. The best is 0.15. Your prices are 350, 400, 550, 350, 400, 550. That is your variable who? Costs. These are the units, so these are your variable costs. Very important that you capture that. That is your variable cost there. Okay? Then we can then determine your contribution margin. Your contribution margin multiplied by the units will give us what we refer to as total contribution. Remember, how do you get your contribution margin? It is simply the difference between your selling price, and remember, your selling price was set as what? 1,000. Your selling price was set at 1,000. So to get your contribution margin, you simply take your selling price minus your variable cost. Minus your variable cost. And how will that be? You're going to take 1,000 minus 350. 1,000 minus 350. 1,000 minus 350. Let's say 1000 minus 350. Then you multiply by the units. And how many units were you selling? 45,000. So please confirm that that is 45 million times 650. This is 29 to 50,000. So my values are in thousands. My values are in thousands. Then again, determine your contribution margin by taking your selling price 1000 minus 400. I believe now you have understood that. Times your units, and your units were 45,000. 1000 minus 550. How many units again are you selling? 45,000. 1000 minus 350. Yeah, your selling price is not changing. You multiply by who? Your units now, for the most likely scenario, are 50,000. 1000 minus 400. Again, your units are 50,000. 1000 minus 550. You multiply by 50,000. That will give you your contribution. 1000 minus 350. Your units under the best scenario is selling 55,000. 1000 minus 400 by who? By 55,000. 1000 minus 550 by who? By 55. Then we now get our who? Totals. We then now get our who? Totals. We need to get our totals. We get our totals. 600 by 45,000. That must be 27 million. 1000 minus 550 by 45,000. That must be 20 to 50,000 times 50,000. That must be 32,500. That must be 30 million. 1,000 minus 550 by 50,000. That is 22,500. 1,000 minus 350 times 55,000. 35,750 million. 1,000 minus 400 by 55 is 33 what? Million. 1,000 minus 550 times 55,000. 24,750,000. That will give you your who? Contribution. That will give you your total who? Contribution, which is your contribution margin times your units. Then you then subtract your who? Fixed costs. So we let's have our who? Fixed costs. And I will have my fixed cost in thousands of what? Shillings. So you need to indicate that. Your fixed cost, what were they saying? Note number 2. The fixed cost attributable will be how much? 24 million. So this should give you 24,000. 24,000. 24,000. 24 again. 24. 24. 24, 24, and lastly who? 24. Now with that, we then need to get our who? Profit. Remember, they wanted us to get our what? Expected profit, which we know. For us to get our expected profit, we need to get our profit. We multiply by our probability. So let's start by getting our profit. 29 to 50, which is your contribution, minus your fixed cost of 24 million. This will be 5250. 27 million minus 24 million, that will give you 3 million. 2250 minus 24 million, that will give you a negative profit of 3750. 32,500 minus 24 million, that is 8,500. That is 6 million. 22,500. Is that 1,500? Yes, it is. Minus 24 is 1,500. 35,750. Minus 24 million. That must be 11,750. 33 million minus 24 million, that is 9,000. 9,000 or 9 million. 24,750 minus 24 million, that is how much? 750. We then will introduce our joint probability. Our joint probability, which we simply denote as JPO. Why are we doing that? We are doing that so that we now take our profit by our joint probability to get our expected profit. Our expected profit. Your joint probability will simply take the probability of units, you multiply by the probability of your variable cost. For example, 0.3 by 0.9, 0.3 by 0, it should be 0.3, eh? The other one is what? 0.3, you multiply by who? 0.55. I'm indicating this because it is necessary, so that you together 0.3 by 0.15, very nice. Must indicate this. 0.6 by 0.3. 0.6 you multiply by who? 0.55. That was 0.6 by 0.55. 0.6 by 0.15. Best 0.1 by 0.3. 0.1 by 0.5. 0.1 by 0.15. Sorry about that. We then get our joint probabilities now. Our joint probabilities. 0.3 by 0.3 is 0.09. Then 0.3 by 0.55 is 0.165. 0.3 times 0.15, 0.045. 0.6 by 0.3, 0.18, 0.6 by 0.55, 0.33, 0.6 by 0.15, 0.09, 0.1 by 0.33, 0.30, 0.03, 0.055, 0.015. Wonderful. Let's then get our expected profits. Our expected profit by taking your probability, you multiply by your who? Profit. The probability, you multiply by your profit. So 5250, and this was in thousands of shillings. Remember that is in thousands of shillings. 5250 by 0.09. 5250 by 0.09. That is 472.5. 3000 by 0.165. 495. 3750 by 0.045. This will be 168.75. 8500 by 0.18. 1530. It is very, very necessary. As much as it looks exhausting and very involving, you need to do this. 1500 by 0.09. 130. 11750 by who? 0.03. 352.5. 9000. 55. 495. 750 by 0.015. 11.25. Once you've gotten the product of your probabilities and your what? Your profit to determine your expected profit, you then now get your totals. So you must get your what? Totals. And this, remember, is your expected who? Profits. Expected profit. So you now simply add 472.5 plus 495 plus 168 plus 0.75 plus 1530 plus 1980 plus 135 plus 352.5 plus 495 plus 11.25, which will give you 5640. Which will give you 56 what? 40. 5640. So therefore, we can say that, and this was a loss, This was a loss, 22 minus 24, that is a negative profit. The same case with this one. We have left out those negatives. Is there any other negative? That's a profit, a loss, a profit, and a profit. So let's compute this answer again because of the what? Of the negatives, of the negative profits. We left out that, but the good thing is that we have captured it. So let's add again. 472.5 plus 495 minus 168.75 plus 1530 plus 1980 minus, this is a negative, 135 plus 352.5, which was a positive, plus 495 plus 11.25, 5032.5. That will give you your expected what? Profit. That will give you your expected profit. That is the first part of that question. The first part of that question is saying, using a probability tree, compute the expected profit of what? Vera. The next part of that question, part 2, that was part 1. Part 2 of that question, compute the probability that Vera Enterprises will fail to break even. Compute probability that Vera will fail to break even. To break even. The probability that Vera will fail to break even is here. 0.045 plus 0.09. Why? At break-even point, your profit is equal to your 0. Okay, so anything less than 0 basically means your company is not able to break even. And as you can see, with a probability of 0.45, your profit is negative. With a probability of 0.09, your profit is negative. So you have not been able to cover your costs. So this will be given by 0.045 plus 0.09. 0.09. It should be 0.045 plus 0.09, 0.135. You're not able to break even from here. The third part of that question, lastly, the last part of that question, determine the probability that Vera Limited will not achieve a target profit. Compute probability that Vera will not achieve. How much is your target profit? Your target profit, they were saying, was 6 million. 6 million. So where will you not be able to achieve your target profit of 6 million? That first is not achieving. You're also not achieving that you have achieved, that you have achieved, that you have not, that you have, that you have, that you have not. So we take the joint probabilities. The first one is 0.09 here. The second one is plus 0.165 here. The third one is already a loss, plus 0.045 plus, that is a profit of more than 6. That is also okay. That is a loss with a probability of 0.09. That is a profit of more than 6 is okay. That is a profit of more than 6 is okay. That is less than 6 million. So 0.015. So then what do? We simply now get the total. So for the company not to be able to to achieve a target of what? Of 6 million profit, the probability is 0.405. 0.405. And that is all that is required in that particular question. That is all that is required in that particular question. All right. That is how you deal with probability tree diagram. So as far as your conditions of uncertainty is concerned, in the next lesson, we are going to talk about continuous or normal distribution method. Continuous or normal distribution method. And I would like for us to attempt a question. And from your previous illustration questions, you can attempt November 2017. So your assignment, this is an assignment. This is your homework. This is an assignment. So you can attempt a question of November 2017. November 2017. And the specific question is question 4A. BPO Limited. BPO Limited. BPO Limited. Right. So thank you so much. We can call it a day and then have a good time. Ordinary least squares method, sometimes also known as regression. First of ordinary least squares, which is simple linear regression method, which is a cost estimation method that requires you to form simple linear regressions of the form y is equals a plus what? Bx. Okay, where a is given by the summation of y minus b summation of x divided by who? N. Then the value of b is n summation of xy minus the summation of x summation of y by n x squared minus the summation of x. You do what? You square. You square. Now the difference between these two, is simply this: you're squaring x individual, but here you first get the total of x, then you do what? You square. You first get the total of x, then you do what? You square. All right. There are certain steps we can follow. Your steps using your calculator. And the calculator I want us to use is FX82MS. Is your calculator known as FX82MS. The first step there is always to switch on your what? Calculator. Always to switch on your calculator. That is a first step. Once we have switched on our calculator, the second step is to reset your calc. Reset the calculator. Reset the calculator. And you reset your calculator by pressing. Shift mode all, which is given by number 3, then equals. That is the second step, resetting your calc. Now you reset your calculator because you may have previously saved data. And that previously saved data will affect the results of your equation. So therefore reset it so that it doesn't affect the results of your current result that you intend. The third step is to do what? Is to set calculator in a regression mode. How do you do that? you press mode, then regression, then regression is denoted by number 3, then linear denoted by number 1. Step 4. Step 4 is input your data. When you are inputting your data, how do you input it? You input it in the form of x, comma, y, m plus. X, comma, y, m plus. This m plus here simply means memory addition. That m plus there means memory addition, which is the same function like in your computer known as what? Save. So this is known as save. So you add that, or you press m plus so that you can add data in your calculator and store it there. Then I want us to do this December 2024 together. We do this December 2024 together. And I want you to show you how we input that data, how we input it. I hope we have reset our calculator. We have set up the calculator in regression mode. I want to show how now you input it. X is 1425. So what do? You're going to press 1425 in your calc. Then next to the DEL and AC buttons, you press 12185 and then M plus. Remember, the comma and the M plus are slightly above the DEL and AC buttons. Slightly above the DEL and AC buttons. If you press 1425, comma, 12185, M plus, N should give you 1. N is equal to 1. The next observation is 950, comma, 9875, M plus. So that is the second observation. The third observation is 1190, comma, 10450, M plus. The fourth one is 1690, comma, 15 to 80, M plus. 1006, comma, 9915, M plus. 834, comma, 9150, M plus. 982, comma, 10133, M plus. 1259, comma, 11981, M plus. 1385, comma, 12045, M plus. 1420, comma, 13180, M plus. 1125, comma, 11910, M plus. 980, comma, 10431, M plus. So that's now the last observation of 980, 10431. After you press M plus, N will be equal to 12. N will be equal to 12, okay? Then the next step is to obtain your data. The data values which are unknown to us. And so far you don't know the value of all this, you also don't know the values of all that. But since you have imputed everything in your calculator, you can be able to obtain them. And how do you do that? You simply press Shift 1. Press Shift 1. When you press Shift 1, the first screen, there is a summation x squared, the summation of x and who? N. To select any value, you press the number below it. For example, when I want this summation of x squared, I'm going to press 1, then equals. So that will give me 17, 483, 772. Press shift 1 again. When I want the summation of x, I simply press 2, then my equal sign. 14186. Shift 1, then n is given by number 3. I remember to press my equal sign. That will give me 12. Okay, that being the first screen, we can go to the next screen by pressing shift 1 and your arrow key. Shift 1 and your arrow or direction key to the right. In the calc, there are 4 buttons just on top of your calculator. Between alpha and mode, there are 4 direction keys there. So you're pressing shift 1 and moving to the right, such that the summation of y squared can be obtained by pressing 1, then equals 370, 811. Shift 1, the summation of y, move with your direction key, the summation of y is 136, 535. The summation of xy all right. Now, if you look at your formula for b here, we have everything except this here. This is the only item you don't have. But since we know the summation of x, we simply square it and say the summation of x squared will be 14,186 squared. Will simply be 14,186 squared. Right, that is when you use shift 1, or that is how you use shift 1. Now, to obtain our values of a and b, we can simply use what? Shift 2. And we move with the direction key twice to the right, shift 2, and move to with the direction key twice to the right, starting with a. A, you're going to press the number below that, which is 1, then equals 295. Shift 2. B, the number below that is 2, so press 2, then equals 6.48 692. But we know our equation should be of the form y is equals a plus what? Bx. The value of a is 3709.295 plus 6.48 692 of who? X. 6.4869 2 of who? Of x. And that is how we form equations using what? Simple linear regression method. Using simple linear regression what? Method. Right. The next thing we should be doing, or I should show you, is how you're going to deal with multiple regression. So multiple regression. Allow me to do away with this. We will come back to evaluation. There's a concept there. So we will need to evaluate. I'll show you how to evaluate your what? Regression equation. But before that, let me show you how we deal with what? Multiple regression. Before we come to the evaluation, let's talk about multiple regression. Multiple linear regression method. Just multiple linear regression. Now, with multiple linear regression method here, this is a regression method where you use it when you have more than one independent variable x. When we talked about simple linear regression here, x is only 1, y is equals a plus b, x is only one independent variable. But it is possible that you have more than one factor affecting your costs. Okay, so where you have more than one independent variable or a factor affecting your cost, you're going to introduce the concept of multiple linear regression method, but your equation is still a straight line. So it must be of the form y is equals a plus b1 x1 plus b2 x2 all the way to bn xn, where x represents your independent variables. How many independent variables are there? So if you have an independent variable for who? For income, you will have it. If you have an independent variable for age, you're going to do what? To have it. So either way, this is how you form a regression what? Equation. That is the general form of your regression what? Equation of more than one independent variable. Of more than one independent what? Variable. All right. Once that is done, I want to show you how you do what? How you're able to form what? Predictor equations. How you're going to form predictor equations. So I want us to go to last sittings question. So I want us to talk about April 4B. Question 4B. April 2025. Question 4B. They're saying Global Logistics Limited has two operating segments, Longonot and Zoea. Longonot division orders most of its consignment of immediate output from Zoea division using economic order quantity model. The managers of each division are given considerable autonomy in transfer pricing policies. Longonot division managers want to use multiple linear regression analysis to evaluate the significance of the independent variables on material handling of cost of its consignments. And they also say the finance director of Global Logistics has availed the following data for Longonot Limited for the past 10 months. You have your month, your material handling cost is Y, number of orders is X1, number of kilograms is X2. The computer output is as follows. So you have that note number 1. Then analysis of variance table, you also have it there as number 2. And number 3, then required, write down the multiple linear regression function of y is equals to a plus b1 x1 plus b2 x2. So allow me to copy this table. There are 2 tables, or rather there are 3 tables that I will need to copy so that I show you how you get those what. This is called an ANOVA table. It's the one I want to copy, which is what we refer to as analysis of who? Variance. Analysis of variance table. I'm copying this so that I can show you how you obtain your various what? Various equations when you're given an ANOVA table. When you're given an ANOVA table, I want to show you how you get your regression equation. So you have your regression. Regression is also known as model, residue is also known as error. 2, 7, total is 9, 34, 6, 1, 3, 0, 2, 0, W, 34, 653, 200, 17, 30, 65, 10, 57, 39.99, 15.06, 076722. Then you have your parameter estimate table. you will have your variable, coefficients, standard error, and your t ratio value of your intercepts, x variable 1, x variable 2, 5 of 7.3097, 7.83, 5162. $57, 32.25, that is Z, 0.0037, 42, 8.85, 009, 8, 33.47672. This is 28. To 286. Okay, here there are some certain variables that are unknown. This is W. Let me use a different color pen. That is Z. That is it. Okay. Now, the first part of that question, they're saying write down the multiple linear regression. The form y is equals a plus b1 x1 plus b2x, b1 x1, a plus b1 x1 plus b2 x2. Now, the first thing you realize is that x1 and x2 you must be given, okay, and also that you must be given, where we know x simply means the independent, y means the dependent. In this case, x1 is number of orders. Number of who? Orders. X2 is the number of kilograms. You must select those two. Number of kilograms ordered. Y is your material handling cost. Y is your material handling what? Cost. So Y will be, you know, A is normally the what? The independent variable known as the intercept of Y, and the intercept of Y is here. The intercept of the coefficient, so Y is 507.3097 plus the coefficients of x1 and x2 are the ones you're going to refer to as your what? B, B. So B1 here will be 7.835162 of x1 plus 0.10781 of x2. So these coefficients here are the ones that give you A, B, and all the B's. All right, that is that. Part 2 of that question. They were telling us, suppose in the month of April, long or not division expected to have 350 orders. with 17,000 kgs of material ordered. Predict the total material handling cost for the month of April 2025. So this second part here is what we refer to as estimation or forecasting. Forecasting is where you use your relationship here. This relationship is cost estimation. Use this relationship to predict future what? Cost. So they are simply asking you for your future what? Material handling cost. When you have ordered how much, you have made 30 orders and received 17,000 what? Kgs. So you're going to say y when x1 is equal to who? 350 orders, and x2 is equal to who? 17,000 is equal to 17,000. So you simply now substitute, the equation of y is 507.3097 plus 7.835162 times 350 plus 0.10718, but you are ordering 17, you received 17,000. So let's work this one out. 507.3097 plus 7.835162 by 300 plus 0.107181 by who? 17,000. So the total cost of what? Of materials is 4679.9353, and that is how you deal with what? How you deal with multiple linear regression, on how you solve your what? Your equation, alright, or how you form your equation. That is good. Now, once you have formed your equation, the next thing we should do is to evaluate. What is this equation good for prediction, or is this equation using the least squares or the simple linear regression, is it significant, or can it be used to predict? Or if used to predict future cost using these two equations, are the costs going to be accurate, or are they not going to be accurate? So, and for you to do that, you now use various methods of what? Analysis of what? The regression equation. There are various methods that we tend to use to analyze your regression equation. The first method is what we refer to as economic plausibility. We refer to it as economic what? Plausibility. So now we are introducing another concept. We are introducing another concept of analysis or analysis and interpretation of regression what? Equation. Analysis and interpretation of regression equation. Okay, which is still under this. Welcome to Manifested Publishers. My names are Mr. Mariga. I'll be teaching Advanced Management Accounting, and today we will continue with the topic of planning and decision making technique. Specifically, I want us to talk about the various applications of marginal costing. The various applications of marginal costing. Now, marginal costing is a method of costing, or is a costing method that requires the user to determine variable costs, such that your variable costs will comprise of direct materials, direct labor, direct expenses, and variable overheads and variable overheads. Right. This method, known as marginal costing, is also known as contribution costing, or variable costing, or direct costing, It is referred to the above names because you consider you consider direct cost as part of your production costs. You also consider variable cost when you're determining your production costs, So therefore, using marginal costing, your variable production costs will be made up of direct materials, direct labor, direct expenses. Then you're also going to add your variable production overheads. Apart from that, apart from knowing how you determine your production cost using marginal costing, it is also important that we remind ourselves how we determine contribution. So contribution is the difference between your selling price and your variable costs. So it is a difference between selling price and variable cost. This particular concept was covered when we were talking about cost volume profit analysis, both in intermediate level, and we have also covered it in advanced level. However, today I want us to talk about the various applications of marginal costing. So today I want us to talk about the various applications of marginal costing. So the applications of marginal costing is what I want us to do to talk about. The applications of marginal Remember, we've said marginal costing is also known as direct costing. It is also known as what? Contribution costing. It is also known as variable costing. It is also known as variable costing. Why? Because you normally calculate your production cost by considering only variable production costs. Only variable production costs. All right. The first application of marginal costing, application number 1 that we will talk about, is what we refer to as limiting factor. It is known as limiting factor analysis. We have a second application known as throughput analysis. Throughput analysis is the second application. You have make or buy decisions. Number 4, you have special offer decisions. Number 5, you have drop or continue decisions. Let me start by highlighting the first application of marginal costing. Let me highlight or talk about the first application of marginal. And the first application is limiting factor analysis. Limiting factor is what is referred to as a scarce resource. So a limiting factor is a resource that is not enough, such that it will normally prevent the company from meeting its demand. So limiting factor is a scarce what? Resource. This is a scarce resource. Is a scarce resource. A resource that is not enough, i.e. a resource that is not what? Enough, or is limited in its availability. In its availability. In its availability. It is limited in its what? Availability. I.e. it is not what? Enough. That resource that is not enough, it may be materials, it may be labor, it may be production capacity, it may be even what? Space. Okay? As an organization, when you are faced with a limiting factor or where you don't have enough resources, you are going to maximize the contribution per limiting what? Factor. So when you don't have enough resources, you as an organization should decide on the units and the product of the product you're going to do what? Produce, such that these products that you're going to produce are the ones that are going to generate the maximum contribution. Now, for us to be able to deal with a question on limiting factor, or for us to be able to identify the product that will maximize the contribution per limiting factor, we must always start by identifying the what? The limiting factor. So the steps that we follow when you want to identify your limiting factor units to produce, steps to follow. Number one, start by identifying your limiting what? Factor. You determine limiting what? Factor. Once you've determined the limiting factor, the second step is determine your contribution. You must determine your contribution per unit, per product. You determine your contribution per unit, per who? Per product. Number 4 is you're going to determine your contribution. Determine your contribution per limiting factor. Per who? Per unit. Per who? Per product. Per unit, per who? Per product. Next step after that is to determine your to rank, or to determine the rank of your products. And the rank here, or the products that you're going to rank, will be ranked that the product with the highest contribution per limiting factor will be ranked first. Will be ranked what? First. And remember that the contribution per limiting factor per what? Per unit will have been computed by note number 4. Will have been computed by step number 3, not number 4, by step number 3. So we are saying you rank according to the highest contribution, per limiting factor per unit. That should be your order of what? Rank. Then step number 5, you determine your optimal who? Output. And this optimal output in step who? D. This step here above. Right. That are the basic steps, or those are the steps that are going to be used when an organization is faced with a limiting what? Factor, a scarce resource. And we can have an illustration. We can have an illustration. And our first illustration, the illustration I want us to talk about, is a question of April 2022. April 2020. April 2020. Question 2A. April 2022. Question 2A. The question states, Zinc Limited is a local manufacturer of 3 products, namely X, Y, and Z. The management of the company is unhappy with the current production mix and is seeking advice on the most optimal arrangement. The current production is 10,000 units of X, 5,000 units of Y, and 6,000 units of Z. The management accountant has provided the following information relating to the 3 products. You have your details. You have the product X and Y. The selling price per unit of X is 1,200, of Y is 2,000, of Z is 2,250. Your production cost of materials is 300, of Y is 900, of Z is 600. Your variable overheads of X is 150, of Y is 400, of Z is 450. Additional information. Each type of product passes through 3 departments in which a different type of labor is used. The labor requirements in each department are given below. Department 1, your rate per hour is 20 shillings per hour, where X requires 3 hours per unit, Y 4 hours per unit, Z 6 hours per unit. Department 2, the rate per hour is 40 shillings per hour. Your labor requirements are 1 hour per unit in X, 2.5 hours per unit in Y, 4 hours per unit in Z. Department 3, your rate per hour is 30 shillings. Your labor requirements per unit of X is 5, Y is 7, and Z is 9. Number 2, if there is a shortage of labor in Department 2 and it is not possible to increase labor input hours beyond the fully utilized current hours. Fixed overheads are budgeted at 5 million shillings per annum and are expected to remain constant. A recent market survey disclosed that the maximum sales potential for the company is 12,500 units of X, 7,500 units of Y, and 8,000 units of Z. Advise the management of Zinc Limited on the most profitable production mix and the optimal profit using limiting factor. So I want us to tackle this question of April 2022. Question what? 2A. Let me have that here. We will follow the steps as I have indicated. It is limiting factor, remember. Okay. So the first step is your first determine the limiting what? Factor. That is step number 1. So we even write here. Step 1. A. Determine limiting what? Factor. Going to guide you through this slowly so that you see what is happening. So determine limiting what? That is the first step. The limiting factor will be determined by comparing the available resources with the required what? Resource. So here we compare our available what? Resource with your required resource. They are saying currently, note number 2, that there is a shortage of labor in Department 2. So here you're going to say your available labor hours in department what? 2. Your available hours in department 2, we're going to have to calculate them now that you've not been given how many hours are available. But additional information number one, each type of product passes through 3 departments in which a different type of labor is used. The labor requirements in each department are given below. The labor requirements per unit of X in department 2 is 1 hour, but for you to produce X and your current production is how many units? 5,000 units. Therefore, the labor requirements of what? Of Y will be what? 2.5 by who? By 5,000, which in this case will be how much? 12,500 what? Hours. The third product is who? Z. And to produce Z, you will use 4 hours per unit. You multiply that by your current production, which is 6,000 what? Units. So for you to produce Z, you require 24,000 what? Labor hours in department what? 2. Then after that, you now determine all your total labor hours that the current department 2 has. All the labor hours. Department 2 has all the labor hours that are available in department 2 for Zinc Limited. And how many hours do you have available? 46,500 who? Once you've determined your available labor hours, what do you then need to do to determine your who? You will need to determine your required labor hours. Your required labor hours in department who? In department who? Again, you will need to produce X, you will need to produce Y, and you also need to produce who? Z. For you to produce a single unit of X, you need 1 hour per unit, but the 100 who? Hours to be able to fulfill that particular what? Demand. Y, you have 2.5 hours per unit, but the market demands that you produce 7,500 who? Units. Therefore, you require how many hours? You require 18,750 hours. Then Z, you require 4 hours per unit, or you'll be using 4 hours to produce a single unit, but your demand in the market is of 8,000 units. Therefore, your total required labor hours are 32,000. So you add this 12,500 plus 18,750 plus 32,000. So here you will need, or you require, 63,250 hours. 63,250 hours in which department? In department 2. Then let's see how much deficit we have. Let's see the deficit. You available labor hours are 46,500 labor hours, but what you currently require is 63 what? 250. Therefore, you have a deficit or a shortage or a shortfall of 46,500, 63,250. Therefore, you have a shortage of 16,700 and what? 50 skilled labor hours in department what? 2. Labor hours in department. Now, because you don't have enough hours here to produce all these units of what? X, Y, and Z, you must decide of the 3 products, which one am I going to produce first? Which one am I going to produce last? Apart from deciding the order of the products you're going to produce, you also will need to determine the units of each product that you are going to produce in that particular what? Period. For us to do that, now that we've determined our limiting factor, we will determine our contribution per unit per who? Per product. But before we determine that, let us therefore here say, therefore, your labor hours in skilled, in department 2 rather, in department 2, it is the limiting what? Factor. The limiting who? That is a limiting factor. How do we know? Because here we have a what? A shortfall or a deficit. You require for 63, but you only have what? 46. You can only use what you have, okay? So therefore, your limiting factor per unit, X is who? 1 hour per unit. Y is who? Is 2.5 hours per unit. And Z, lastly, is 4 hours per who? Per unit. 4 hours per unit. That is the limiting factor per who? Units. And that is also how you determine your limiting factor. Remember, we said a limiting factor is a scarce resource. Those hours of 16,750 represent the scarce hours you don't have. Step number 2 here is to determine your contribution per unit per who? Per product. So let's determine our contribution per unit per product. Contribution per unit. To determine contribution per who? Per unit. Let's determine contribution per unit. How do you determine contribution per unit? The contribution per unit is normally calculated by taking the difference of your selling price per unit and your total variable cost. So we can start with the first product. The first product is known as what? Again, we are going to take your selling price per unit. The selling price per unit of X is 1200. You less your variable cost, and the first variable cost is the cost of direct materials. And your material cost is how much? 300. You have another variable overhead cost, is your other variable cost, which is 150. Then you also have a cost known as direct labor cost. And your labor cost was in department 1, department 2, and department 3. Department 1, you are using 3 hours. Department 1, you are using 3 hours at a rate of how much? 20. So that your labor cost is how much? 60. Department 2, department 1 is being paid at how much? 20 shillings per hour. So if you work for 3 hours, you're going to be paid 60 shillings. Department 2, you're being paid at 40 shillings per hour. And department 2, they worked for how many hours? 1 hour. So therefore, they were entitled a cost of how much? 40. Department 3, they're working for 30 shillings per hour. And they worked for how many hours? 5. So 30 by 5 must be 150. Then we determine our contribution per who? Per unit. We've said the contribution per unit is simply the difference between your selling price and all your variable what? Costs. Let's go to Y. Your selling price per unit ni ngapi? 2000. Your material cost is 900. Your variable overhead is what? 400. Your labor cost in department 1 which was paid at 20 shillings per hour, but they worked for 4 hours. So 20 by 4 is 80. Department 2, they worked for 2.5 hours. They worked for 2.5 hours, but each hour is being paid at how much? 40. So therefore, they will be paid how much? 100 shillings. Department 3, they worked for 7 hours and each hour is being paid at 30. So that they will be paid how much? 10. The other department is department who? Z's. Your selling price 22.50. Material cost 600. Variable overhead cost 450. Labor cost of 6 by 20 120. Department 2, 40 hours per hour by 4 hours is 160. 30 hours, 30 shillings per hour by 9 must be 270. Then we now get our contribution. The difference between what? Selling price and all your variable costs and all the variable costs. Okay, so let's calculate it now. Let's calculate it. Remember, we are determining our contribution per who? Per unit. 1200 minus 300 minus 150 minus 60 minus 40 minus 100 and what? 50. The contribution per unit of X will be 500. 2000 minus 900 minus 400 minus 80 minus 100 minus 200 and who? 10. 210. 2250 minus 600 minus 450 minus 120 minus 160 minus 270. That must be 600 and what? Step number 2 is done. So let's go to step number 3. Step number 3. I hope we are together. We have successfully determined the contribution per unit. The next step on dealing with limiting factor is to determine your contribution per who? Per limiting factor per unit. So let's go to step number 3. Factor per unit. Determine contribution per limiting factor per unit. You have X, you have Y, and lastly you have which product? Z. To determine the contribution per limiting factor per unit, you're simply going to take your contribution you divide that by your limiting factor. And your limiting factor, remember we said, is your labor who? Hours. So you're going to divide this by your labor who? Hours. You're going to divide that by your labor what? Hours. Your labor hours. Per unit. X, Y, Z. The contribution per unit is as per step 2, 500, 310 and 650. 500, 310, and lastly how much? 650. You divide that by your labor hours per unit. That is the limiting factor. Remember, these labor hours per unit are the limiting factor. X is 1 hour, Y is 2.5, Z is 4. So you say 1 hour per unit, 2.5 hours per unit, and 4 hours per unit. So this will give you your contribution per labor hour per unit. Per unit. 500 divided by 1 is 500. Then 310 divided by 2.5 must be 124. 650 divided by 4 must be 162.5. 162.5. We have determined the contribution per limiting factor by simply doing what? By taking the contribution, you divide by your limiting what? Factor. And remember, your limiting factor was the labor what? Hours. It was the labor hours. The fourth step is to rank, or what we simply denote as priority ranks. When we say priority rank of production, it is basically you want to identify of the 3 products you want to produce. Which one will you produce first? Which one will you produce second? Which one will you produce the third one or the last one? You want to produce X, Y, and who? Z. Now, the ranking here is normally based on what? It is based by the maximum, or you compute it, or you consider your maximum contribution per limiting factor. So once you've determined your contribution per limiting factor, you're going to look at the one with the maximum what? Contribution per limiting factor. That you're going to rank it as number 1. Then the second, you're going to rank it as number 2, and so on and so forth. Our contribution per limiting factor, which is your contribution per labor hour per unit, was how much? 500 for X, 124 for Y, 162.5 for who? Z. Then you do what? Rank. According to the contribution per limiting factor above, the first rank should be product 1. Product 1, which is what? X. Let me write that using a different color pen. Product 2. Then product 2 is Z. Then product 3 is Y. Because the one with the highest contribution per limiting factor is X. Then the next highest is Z. Then the least highest is what? Y. That is step number 4. Step number 5 is now to determine the units of output you're going to do what? That you're going to produce, what we refer to as optimal production mix. Optimal production what? Mix. So here we want to identify according to the ranks here, and now that we only have 46,500 hours, how many products of each product are we going to produce? How many units of each product are we going to produce. So you're going to start here by identifying the products according to the rank here. Then have your available limiting factor, and we know what is our available limiting factor. Your available limiting factor is your labor hours. Your labor hours was the limiting factor. Then your required labor hours, which is now your required limiting factor. Then lastly, you have your output, and your output is in what? Units. Your output is in units. Wonderful. The first product we want to produce according to our rank is what? X. So here we write product X. The available hours that organization currently have is 46,500 hours. So here you write 46,500 hours. For you to produce product X, the required labor hours here are how many hours? 12,500. 12,500. And then now we need to identify our output. Okay, but remember that X, for you to produce a single unit, you are using how many hours? 1 hour. So if you have 12,500 labor hours, what to produce? So what will you do? You're simply going to take your required hours, 12,500, you divide by the labor hours per unit, which in this case was how much? 1 hour. So at the end of it all, you will need to produce 12,500 units. 12,500 units. The next product according to our rank is product Z. We write here product Z. Now your available hours will have to do what? To change. Why? Before production of X, you had 46,500 labor hours, but you have used how many labor hours? 12,500. So for you to produce Z and Y, you only have how many labor hours now available? 34,000 labor hours, which is simply 46,500 minus 12,500 to give you 34,000. Then we ask ourselves, for us to produce Z, how many labor hours do we require? And we require how many labor hours of Z? 32,000. 32,000. So here we are going to write how many hours? 32,000. Then let's identify the units we want to do what? Produce of Z. For you to produce a single unit of Z, you required how many hours? 4 hours per unit here. If you currently have 32,000 labor hours, how many units are you going to use to produce? So you will take 32,000, you divide by by 4. So you're going to produce how many units? 8,000 units. 8,000 units. The last product that we will produce, that we should produce, is product Y, because it is the one that was ranked number 3. For you, before you produced Z, you had 34,000 labor hours, but you have used 32,000. So therefore, how many hours are remaining? 2,000. But for you to produce Y, you require how many labor hours? 18,750. Now that you don't have 18,750, how many hours are you going to use? 2,000. Remember, you can only use what you have. Okay, so here, even if you require 18,750 hours to produce Y, what do you currently have available? 2,000, and these 2,000 labor hours are the ones you're going to use to produce a certain number of units of Y. And how many units are you going to produce? You're going to take your hours that are required, 2,000 hours, then you divide that by how many hours each unit is producing. For Z, for Y, which is how much? 2.5. So you divide this by 2.5. So you should end up producing how many units? 800 units. You will end up producing 800 units of Y. Now that is clear, we have determined the units of each product that will utilize our contribution margin. This question also required us to determine the optimal production mix. This is your optimal production mix here, but they were also telling us to determine our optimal profit. Now, your profit here, we know, is given how? How do you determine your profit? Your profit is determined by taking P minus V. You multiply by the units minus your what? Fixed costs. Minus your fixed cost. But remember, P minus V is your contribution what? Margin. You multiply by your units minus your fixed cost. Minus your fixed cost. Then, so let's determine our contribution. Our contribution, which you know it is your contribution margin. You multiply by your units. But now, these units here, we are going to use the optimal what? Output units. Because they're asking us for the optimal profit. Therefore, the optimal output units here are the ones we're going to multiply by the contribution of each product to determine our total contribution. How is that we're going to do? Let's start with product X. Product X, your contribution margin of X is how much? 500 per unit. You multiply that by the units of X that are optimal. And the units of X that are optimal is how much? 12,500. So you multiply here by 12,500. The next product is Y. And Y, your contribution margin is how much? 310. Then 310, you multiply by your optimal output, which is 800 here. So what? 310 by 800. The next product is Z. Your contribution per unit is 650. You multiply by the optimal output of Z of 8,000. So 650. You multiply by 8,000. You multiply by 8,000. So let's determine that. 500 by 12,500. That should be 6,250. Return by 800 to 48,000. $650 by 8,000. Then you now get the total 6250,000 plus 248,000 plus 5,200. 11,68,000. This will give you your total contribution. But then we need to subtract our fixed costs. Your fixed cost, and how much was your fixed cost? Your fixed cost was given by note number 3, and your fixed cost by note number 3 is saying fixed overheads are budgeted to remain at how much? A constant value of 5 million. So we are going to subtract 5 million. So hapo here your net profit will be how much? 6,698. So therefore your optimal profit is how much? 6698 what? 6898,000. 6898,000. And that is how we did with limiting what? Factor. Now, in case they had asked us, highlight this, in case they had asked us for your maximum profit, sometimes they may also ask for your maximum profit. In case they ask for the maximum profit, yeah, you're going to determine your maximum profit here by taking your contribution margin or your contribution CM by your units of Q. But now these units here are Q are the units that correspond to maximum what? Sales or maximum what? Output. So these Q units here, should be what units? Your maximum units sold. Your maximum what? Sales demand here. And the optimal production mix, when they ask for optimal profit, I hope you've realized and I know you've noticed that these units are the optimal units produced. Optimal units produced here. And these are these units here. But now, when they say what? Determine maximum profit, your contribution will be a product of your contribution margin. But now the units are the maximum available what? Sales. Let me even use this question to show you what I mean by that. We can start with X. No changes to the contribution margin, 500. Then your maximum sales demand was given by additional information number Number 4, where X, your maximum sales is 12,500. Your contribution margin is what? 310. With the maximum sales demand of 7,500. Z is 650. With a maximum sales demand of how much? 8,000. 8,000. So let's calculate this. Let us calculate this. 500 by 12,500. That is 6250. $310 by 7,500. 23 to 25,000. 650 by that is 5.2 million. Your total contribution $6,250 plus 2325 plus 5.2, 13,775,000. Then you less your fixed costs. And your fixed cost, remember, do not change with output. So therefore, they will be how much? They will remain a constant of 5 million. Your net profit is 87,75,000. Therefore, maximum profit is how much? 87,75,000. 87,75,000. And that is how we deal with limiting what? Factor. With limiting factor, a scarce resource. Right. Now that we're done with limiting factor, or we have covered the limiting factor successfully and exhausted that, in the next session, I want us to cover throughput counting or throughput analysis. And throughput analysis is very, very close to limiting what? Factor. It is very, very close. So they are more or less related. Still, you want to determine the number of units that you want to produce when you don't have enough what? Resources. All right. So thank you. See you next time. Welcome to Manifested Publishers, Advanced Management Accounting. My names are Mr. Mariga, and we will be continuing with CVP under conditions of uncertainty. So far, we've covered 5 methods of CVP under conditions of uncertainty. We have covered the expected value approach, simulation approach, decision tree, sensitivity analysis. So today, we will cover continuous or normal distribution method. We've also been able to cover statistical analysis method. So out of the 6 methods that are used to deal with CVP under conditions of uncertainty, the one remaining is continuous distribution method or normal distribution method. And that is what we will talk about today. So F normal distribution, then a normal distribution is normally a bell shape, or is a distribution that can be illustrated using a bell. Okay, so we say it is what? Bell shape. So it looks like this. And a normal distribution, we say it is
correctly defined when you have been given the expected value or the mean, and you have also been given the standard deviation. Okay? One half of this normal distribution can be folded to exactly fit the other half. So when you fold this into half, they should exactly fit each other. It is also important to remember that this line do not intersect or meet. Why? Because we say it is what? Asymptotic. Okay? Good. One half of that is 0.5, and that other half has a probability of 0.5. So that when you add them, it is equal to what? To 1. So this x bar is your mean, and that is your standard deviation. Standard deviation. That. Okay? So we can have an example. We can have an example. Of a question where we will be talking about what? CVP. Yeah? So we can say that given a selling price per unit of 1250, a variable cost of 500, your expected sales of what? 200. Expected sales of 200 and expected sales of 200 and the standard deviation, a standard deviation of what? Of 300, and the standard deviation of how much? Can say 300. Compute the break-even point. Compute break-even point. In what? Units. Given that your fixed cost is how much? Your fixed cost is 1.2 million. It's given that your fixed cost is, let's say 120,000. Your fixed cost is 120,000. Okay? The second part, compute probability of at least break even. Of at least break even. At least break even. Then number 3, compute probability of achieving target sales. Target sales given that target sales is is 200,000. Given that target sales is 200 what? 1,000. Target sales profit. Given that target sales profit. So guess that. Target sales profit. Given that target sales profit is 200,000. It's 200,000. Alright. So we can have a solution here. This is a solution. Good. Your break-even point number 1 If you want it in unit, let's say you simply take your fixed cost, divide by contribution margin. Divide by contribution margin. Good. Your fixed cost is 120,000. Divide by a contribution margin. And the contribution margin is the difference between your selling price per unit and your variable cost, which will be how much? 1250 minus 500. That should be 750. So therefore, your break-even point will be 160 units. 160 units. Part 2 of that question is compute the probability of at least break-even. So what you do is you represent this using a normal distribution. The normal distribution looks like that. The mean is you have to look the mean here. Can say that your mean turns out what? And
welcome to Advanced Management Accounting. My name is Mr. Mariga, and today I want us to talk about applications of learning curve model and ABC invariance analysis, which is a topic under budgetary control and control and techniques here. Now, we were tackling cost estimation and forecasting and interpretation. We talked about learning curve, where we said that learning curve here is a method of estimation that takes the general form y is equals a b plus 1 and y bar is equals ax raised to power b, where b we said is your learning curve index, which is given by log learning curve divide that by log 2. X we said is or your outputs, or your output. A is a time or cost of first unit of production of production. Y is a cumulative total time or cost. Y bar is a cumulative average time. Time or cost. Remember, we said that when an employee gets used to doing something, they improve their the rate at which they produce, and that improvement rate, where they take less time or they incur less cost than the first unit they produced, is what we refer to as learning curve, is what we introduce as learning curve. And we also said that NB, your learning curve rate is simply 1 minus your improvement rate. Minus your improvement what? Rate. Right, that I've given you a brief recap of that. Today we want to talk about, or I want us to introduce something on variances, where you have what? A learning curve, where you have learning curve. And we are going to do a question of November of 2020. Let's talk about November of 2020. Question 5. Question 5. November of 2020, question 5 is a question we will tackle today, where they saying High Tech Limited intends to launch a locally manufactured printer in the coming month of December 2020. The Research and Development Department of the company has provided the following information relating to the production of the printer. You have a selling price of 17,500 per printer. Variable production cost, you have direct materials of 800 grams at 7,500 per kg. Direct labor of 75 minutes at 3,000 shillings per hour. Variable overheads of 60% of direct labor hour. Then you have your contribution per printer. Production of the printer is scheduled to commence on 1st of December 2020. The company plans to produce and sell 3,000 printers per month. A direct material loss of 10% is expected, with no resale value. The annual fixed cost attributable to the production of the printer is 60 million. The cost accrues evenly throughout the year. A learning curve effect of 95% is expected. Determine the standard labor cost for the month of December. So let's start with part 1. I want us to determine your standard labor costs. Now your standard labor cost will be determined by your standard what? Labor hours. You multiply by your standard labor rate per hour. Your standard labor hours, you multiply by your standard labor rate per hour. Standard labor cost is given by your standard labor hour. You multiply by your standard labor rates. Which is in shillings per hour. Okay. Your standard labor rate, they've told us currently is how much? 3,000 per hour. But we need to determine our standard labor hours. Keeping in mind that we have what? A learning curve. So let's determine our standard labor hours. So compute standard labor hours. Computation of standard labor hours. Your labor hours will be given by AX B plus 1, where A is the time for the first unit, and the time for the first unit is 75 minutes. 75 over 60 hours, which is 1.25, which is 1.25. Then your output that you had planned to produce is how much? 3,000 units. 3,000 who? Printers. Then B, we know is your learning curve index, which will be your log of learning curve, and your learning curve rate is 0.95 divide by log 2, which is negative 0.074. All right. So let's then determine our labor cost, our labor hours first. You're producing 3,000 printers, rather. The time of the first unit is 1.25, but you're producing 3,000 printers. Negative 0.074 plus 1. So therefore, your total labor hours that will be used to produce the 3,000 units, keeping in mind that you have a learning curve of how many? Of 95%, is that you will use 2073 hours. 2073 hours. All right. So your labor, your standard labor costs, your standard labor cost now, you're using 2073.587056 hours. You multiply that by your standard labor rate per hour, and your standard labor rate per hour was 3,000. So therefore, your standard labor cost is there. Is that 6,220,761.167. All right, that is the first part. Then they're telling us part B to prepare a budget. A budget what? Statement. Budget profit statement. Let's start with your sales. Now this budget profit statement is what sometimes we refer to as an original who? Budget, or a static budget. It is a budget where you consider your activity at the beginning and your cost at the beginning. So we normally say it is a budget of budgeted cost, but for budgeted activity. So when you're determining your sales, you're going to take your budgeted selling price, you multiply that by your budgeted units sold. Your budgeted selling price was 17,500. That you multiply by your budgeted units sold, which were 3,000 printers. Then you less your who? Your costs. The first cost will be the cost of direct materials, your direct material cost. And your material cost, we were using 800 grams at 7,500, but note number 3, this added and said, a direct material loss of 10% is expected with no resale what? Value, with no resale value. So the 800 grams, therefore, are at 90%. What about what? 100%. So what will you say? Going to say 800 over who? 100 kgs. You multiply that by who? By 100. Then times what? Your cost now, your cost in kgs was 7,500 to 7,500. Okay. You multiply by your printers, which are how many? 3,000. Then all these, or let me see, not all these. Then you divide that 100 by what? 90. What have you effectively done? This is what you've done. You've said that 100 is equal to what? 90. What about 800 over who? 1,000. How much will that? That is what we've done there. Why? Because they're telling us that you have a normal loss of 10% of the material. So even if you bring 100, you're going to get what? 90. And our material, how much at 90% is what? 800 grams. 800 grams, which is 800 what? Kgs. So therefore, at 100, how much do we expect there? So you expect what? 0.88. 0.88. So this 0.88 here, which is now this working, you multiply by the price per kg, then times what? 3,000 printers. That is your material cost. I hope that is very clear why we've worked at it that way. Okay, this, I think even that is what I should write here. So let me write that so that it is very, very clear. 0.88 kgs. You multiply by who? 7,500 per kg. But you had produced how many printers? 3,000. 3,000. All right, that is clear. You then add the cost of direct labor. Cost of direct labor. And because of the learning curve effect, your labor cost, we determined it. We determined it as 62, 20, 761.16 Then you did also have variable overheads. Variable overheads, where they were saying they are 60% of direct labor. So 60% of direct labor, 167. Then lastly, you had fixed what? Overheads. Or fixed costs attributable. For the whole year was 60 million, but you want only for the month of December. So you're going to take 60 million. You divide that by how many months? 12 months. You divide that by 12 months. So this is 20 million. This is 37. 324. 56.7. And lastly, your fixed overhead cost is 5 million. So your budgeted profits. This is 556. Huh? All right. That is your budget. That is how you apply learning curve as far as variances is concerned. The next part of that question, where they're telling us to reconcile, we will do that in the next lesson, where I will introduce 3 items or 2 items. Number 1, I will introduce operating variances. I will also introduce planning what? Variances. Alright, those 2 things. But for these 2 to exist, you must have what we refer to as revised standards. You must have revised what? Standards for those 2 to be there, but we're going to talk about them in the next what? Lesson. In the next lesson. So what so far as we've been talking about is conventional variances. Conventional variances, or you simply compare standard or what? Original with actual. You're operating here, you compare your revised and your actual. This one, planning, is your standard and your actual, but we'll talk about that in the next lesson in more detail. So from me, goodbye and see you next time.
Hello candidates, and welcome to the Manifested eLearning platform. Today we are continuing with the topic Planning for Governance and Compliance Audit. The subject is Governance and Compliance Audit. In our last session, we discussed the audit risk, threats, and safeguards. Previously, we had learned how to develop the audit strategy. Today, we are moving to the development of audit plan, program, and procedures. Those are 3 areas: audit plan, audit program, and audit procedures. And developing these 3 candidates is the final and the most detailed step in planning the phase, in the planning phase of an audit. We've been learning quite a lot about planning for an audit, and I'm saying that the audit plan, developing an audit plan, developing audit program and procedures is a final part of the planning phase of a governance and compliance audit, because these 3 then transforms the high-level audit strategy into practical, step-by-step guide for the fieldwork. Before the auditors go to the fieldwork, there has to be a plan, a program, and procedures which stem from the audit strategy, which is a high-level guide. So these 3 are step-by-step guide for the auditors who are going to the field. And the phase of developing the audit plan, program, and procedures ensures that the audit is systematic, ensures that the audit is comprehensive, and focused on achieving the stated objectives. You understand? Now, just like any other event, candidates, if you want to carry out an event, be it a wedding event, it could be a music concert, you may have the strategy, you may have the objectives of the event. For the event's objective to be met, there has to be a practical step-by-step guide so that the objectives can be achieved. Do you understand? There has to be a guide because there are many people who may be involved in the process of achieving the objective. So they have to be coordinated. It should be clear who is doing what, and it also happens for the conduct of governance and compliance audit. So let's begin with the audit plan. What does it entail? Audit plan. Now, an audit plan is a formal document that serves as the blueprint for the entire engagement. We all know that a plan is a predetermined course of action. A plan is a predetermined course of action. You determine in advance the actions you are going to carry out. So if you are going to audit, then you must have a plan for the audit, which you are saying is the blueprint for the entire engagement, and it synthesizes all the decisions made during the earlier planning stage, and also it provides a comprehensive overview for the audit team and the stakeholders. Before the audit team goes to the field, before the stakeholders know what is happening, there has to be a plan, there has to be a blueprint that is a predetermination of the actions that are going to be done. So do you understand? That's the meaning of a plan, an audit plan. So what are the components of an audit plan? What is entailed? We want to learn the components, the elements of an audit plan. If you have an audit, a governance and audit plan, what are you likely to find within that plan? So what are the components of an audit plan? If you are to have a look at an audit plan, then there has to be an introduction to that plan, or what we call introduction and background. Let me call it introduction and background. An audit plan will have an introduction and a background. This is just a brief overview of the engagement, including the purpose of the engagement, the scope of the audit, and so on. So number one, introduction. Then number two, the second component of an audit plan is audit objectives. Audit objectives. What are the objectives of the governance and compliance audit? This is just a clear statement of what the audit aims to achieve. That has to be part of the audit plan. Audit scope, number three, is the third element of an audit plan, the scope. The scope outlines the boundaries of the audit. It defines the boundaries of the audit, including the business units that are likely to be audited, including the processes that will be audited, the systems that will be audited, and also those that will be excluded. It has to be clearly stated within the audit plan what will be audited and what will not be audited. 4, audit criteria. There has to be a criteria which is also part of the audit plan. Criteria refers to the specific laws, regulations, standards, or internal policies against which the subject matter will be evaluated. If the auditors are going to audit the IT part of an organization, if they are going to audit internal controls, then there has to be the standards against which the audit is going to be carried out. That's what we're referring to audit criteria. And in our previous sessions, we discussed in detail what audit criteria is. Let's move on to the fifth element, which is risk assessment summary. Risk assessment summary. The audit plan must include a summary of risk assessment. In our previous session, we discussed the risk assessment, assessing audit risk, threats, and safeguard. You recall that is what we covered in our previous session. So there has to be a summary of risk assessment. These are the key inherent and control risks that are identified during the planning phase. And it is this risk assessment that justifies the audit approach. What audit approach will the company take? What audit approach will the firm take in the process of auditing? Is it risk-based approach or system-based approach, or which approach will be used? That approach is based on risk assessment. Number 6 component is materiality and assurance level. Materiality and assurance level. These are very key component of an audit plan. There has to be quantitative and qualitative threshold, materiality threshold, and the level of assurance. Is it a reasonable level assurance? Is it a limited assurance? That has to be provided, and it has to be part of an audit plan. 7, we have audit approach. We may call it strategy, but to differentiate with the overall strategy, let's just call it audit approach. This is a high-level description of the audit methodology. What will be the approach? Is it risk-based approach? Is it a system-based approach? Or which approach will the audit team take in the process of carrying out the governance and compliance audit? Number 8, resource allocation. Resource allocation. These are very critical element, which is just the composition of the audit team, the key roles and the responsibilities. The most critical resource in audit is the audit team, the human resource. Another resource is a time resource, and also the budget for the engagement. Those are resources: the human resource, the budget, and also time resource. That has to be part of the audit plan, resource allocation. Number 9, timing and logistics. Timing and logistics. Timing and logistics. Now here, by timing, we are referring to the key audit milestones. The key milestones and also the dates for the field work. Timing may also include reporting and also follow-up. At what point in time will the audit team go to the field? When are they going to finish the field work? And what time are they to complete, for example, gathering of evidence? For how long will evidence be gathered? Okay. When will the report be drafted? And also follow up. If the audit team makes certain recommendations to the management, when should the auditor make follow up to find out if the recommendations have been implemented by the management of the company? It also includes logistical details like required access to systems and personnel. There has to be logistics on how the auditors are going to access information, how they are going to access documentation, when are they meeting the personnel of the company that is being audited. So that has to be part of the audit plan, timing and logistics. Then lastly, we have communication plan. An audit plan must include a communication plan which details on how and when the audit team will communicate with the management, the audit committee, and also the audited department. There has to be a communication plan on when the audit team will meet the personnel of the company. So that's all for audit plan. These are the key components of an audit plan, which you have defined as a blueprint. Okay? It is a blueprint for the entire engagement. Then let's discuss program. What is an audit program? Audit program. Let's move to audit program. Audit. Now, an audit program may also be referred to as a work program, which is more detailed and a tactical document than the audit plan. A program is more detailed. This is just a blueprint. Okay? But a program is more detailed. You understand? It is the auditor's instruction manual for executing the fieldwork because it breaks down the audit into specific tasks and procedures, ensuring consistency and completeness. So what are the key components of an audit program? Now, one component is a specific audit objective. Specific audit objectives. Specific. That is the first component. Now, each section of the program is linked to a specific audit objective or a key control compliance requirement. You understand? Each section of the program, which you have defined as a detailed and tactical document, which you have defined as the auditor's instruction manual. So each section of that program has to be linked to a specific audit objective. So we have audit objectives here. So each has to be linked to the audit objectives because in the field work is carried out, and every work that is carried out in the field work goes a long way in meeting the objective. So whatever is done in the field has to be linked directly to the audit objectives. Because the audit team has to ensure that the objectives are met. So that's the first element. Then you have detailed audit procedures. Detailed audit procedures. Detailed audit procedures is the second key element of an audit program. These are specific steps the auditor will perform, and they are designed to gather sufficient and appropriate evidence to support the auditor's conclusions. And the procedures are where the how of the audit is truly defined. Okay? Detailed audit procedures. Detailed are the substantive procedures, the analytical procedures. That is part of the audit program. Number 3 is what we call evidence and documentation requirements. And documentation, evidence and documentation requirements. Now, for each procedure, the program specifies what evidence is needed. For example, the evidence may be a signed policy document. It could be a system log. It could be an interview summary, and so on. It must also clearly state how it should be documented in the working papers. So that is another key element of an audit program. Evidence and documentation requirements. Number 4, reference papers. Reference to working papers. Reference to working papers. Now, each procedure is here cross-referenced to the working papers where the evidence will be stored. And this creates a clear audit trail. So reference to working papers is also part of the audit program. The fifth component of an audit program is responsibility and status. Responsibility and status. Responsibility and status. Now, the audit program assigns each procedure to a specific team member and tracks its completion status. Remember, we said that an audit program is a step-by-step guide. It is this audit program that helps actualize the plan. So part of the audit program, there has to be responsibility and status. The program must assign each procedure to a specific audit team member. Which of the audit team members is going to perform a certain procedure and by what time? When will the procedure be completed? It also tracks completion status. At what point in time, if you are to check the progress of the audit engagement, that helps now know whether the audit team members are performing their tasks or not. If the audit team, the field work has gone, say, 50% of the time, is it now possible to check if the team members are on time or not? So that's part of the audit program. Estimated time is yet another component. Now this provides an estimate of the time required to complete. So these are 6 components of an audit program. Now finally, let's discuss the procedures. Audit procedures are the core of the audit program. Procedures are the core. You can see the trend card. This is beginning with the audit program. The audit plan. Then you have the audit program. Then you are discussing the audit procedures. Audit procedures are the core of the audit program. They are the specific actions the auditor takes to gather evidence. And the choice of procedures depends on the audit's objectives, the accessed risks, and also the nature of the subject matter. So what are some of the common audit procedures? Common audit procedures. Common audit procedures. What are the common audit procedures? The common audit procedures include 1, inquiry. Inquiry. To inquire. That means asking questions, and these are questions of management and personnel to gain an understanding of processes, controls, and compliance activities. If the auditor is to gather evidence, then the auditor will have to ask questions. Ask questions of management, ask questions of the personnel in order to gain understanding of the controls and so on. Inquiry is an audit procedure. Example could just be interviewing the IT manager about the data backup process, or interviewing a HR director about the employee training program for the code of conduct and so on. Inquiry. The second procedure is what we call inspection. Inspection. That means examining documents, records, and internal controls for evidence of compliance. Example could be reviewing a signed policy, inspecting a copy of regulatory filing, or even examining system access logs. Inspection. 3, observation. Observing, looking, watching a process or procedure being performed to confirm it is being followed as documented. For example, observing a physical security guard's procedure for checking visitor IDs, or just watching an IT professional perform a system backup. That is a procedure. Observation. watching. For reperformance. To reperform is to perform again. The auditor independently performs a procedure or a control that was originally performed by the client's personnel. For example, recalculating a financial figure or just independently attempting to assess a security system to test the access controls. 5. Analytical procedures. Analytical procedures means analyzing relationships and trends among data to identify unexpected fluctuations or relationships that may indicate a compliance issue. For example, comparing the number of regulatory complaints this year to last year to identify a potential trend, or analyze data to see if specific department is not following a policy. So these are 5 common audit procedures, and that marks the end of our lesson on audit plan, program, and procedures. We have defined what an audit plan is. We have identified key components of an audit plan. We've defined what audit program is. We have identified 6 key components of an audit program. We've defined what procedures are and also outlined 6 minus 1 common audit programs or procedures. So the auditors, if you are called upon to carry out a governance and compliance audit, then you have to meticulously develop an audit plan, program, and procedures so that the audit team ensures that the audit is performed with a high degree of discipline and professionalism. If you are to achieve professionalism and high discipline, then you must have an audit plan, a program, and procedures. And this systematic approach is essential for a successful audit that provides valuable, well-supported conclusions to the management and also to the board. So thank you for your time. We'll meet in our next session where we will discuss preparation of audit working papers. Thank you. God bless you. Bye-bye.
Should be actually not 3A. 3A is a learning curve. So November 2019, question 3B. Where they're saying Dawa Chemical Limited manufactures a single product XP. The following information for the financial year 2018 relates to the product. Number 1, standard material cost per unit of XP. You have your materials, your kgs, and your price per kg, and in total. You have your labor hours. Let's first ignore the labor hours. Then budgeted sales for the period amount to 45,000 units at 260 per unit. There was no budgeted opening and closing inventories of product XP. The actual materials and labor used are as follows. So you have your materials, your kgs, your price per kg, and your total. Compute the note number 5. During the period, 4,100 units of product XP were produced and sold for 1158,000. Compute the following variances: material price variance, material mix variance, your yield, and your labor rate variance. Right. So let me show you this. You have your standard cost. I'm just going to transfer these in the board very fast. Standard cost per unit, so that we move together, of product XP. You have your material, kgs, price per kg, total, which will be in what? Shillings, F, G, H, 15, 12 and 8, 4, 3 and 6. This should be 60. 36 and 48. So that the total is 144. The total there is 35. Okay. Then your actual materials. In fact, I can just have them here. Your actual materials. You have kgs, price per kg, and totals. $59,800, price of 4.25. Your total is 254,150. 53,300. 2.8. 149,800. 33,300. 6.4 and 213, 100 and 20. Then your actual production, or let me say your budgeted sales. Your budgeted sales is 4,400 units, 4,500 units. Actual units produced. So your actual production and sales is 4,100 units. This is your budgeted production. 4,500. Let's start with the first variance. Material price variance. Your material price variance, which is simply denoted as MPV, is the difference between the standard price and actual quantity and actual price, but for the actual quantity. Okay, so here you're going to say MPV is actual quantity, standard price minus actual price. Your actual quantity purchased is 59,800 for who? For F. Your standard price per kg is 4 minus an actual price of 4.25 G. Actual quantity 53,500. Standard price per kg is 3. Actual price is 2.80 H. Actual quantity 33,300. Standard price per kg is 6. Actual price is 6.4. So let's get these variances. 14,950. That is 14,950. Which you're going to say is what? Adverse. 53,500. 3 minus 2.8. 10,700. Which is favorable. It is favorable because you bought at a cheaper price. 6 minus 6.4. 13,320. This will be what? Adverse. Why? Because you bought at 6.4, but you had budgeted to buy at 6. $17,570, which you're going to say is what? Adverse. Remember, you add the adverse, subtract adverse, favorable, and you also add favorable what? Favorable. Okay, let me show you the material usage variance. MUV, which is a standard price, standard quantity of actual production minus actual quantity used. This is the actual quantity used. Okay, your standard quantity of actual production, you say it is your standard quantity per unit, you multiply by actual who? Production. You multiply by actual production. Material F, G, and H. Your standard quantity per unit in kgs was how much? Was 15. You multiply by an actual production of 4100 units. Your standard quantity per unit in kgs is 12. You multiply by who? 4100. This is 8 by 4100. So 15 by 4100. So that means you use 61,500 kgs, 49,200 kgs, 32,800 what? Kgs. You can then add them so that the total standard quantity of actual production is 143,500. But remember, we want our usage variance. So we're going to say, therefore, your material usage variance can start with F. Your standard price is 4 shillings. Your standard quantity of actual production, we've just calculated it as 61,500 minus the actual quantity consumed, which was 59,800. G. The standard price per kg is 3. Standard quantity of actual production 49,200 minus your actual quantity 53,500 here. H. Your standard price is 6. Standard quantity of actual production 32,800 minus 33,300. 33,300. Let's then get our variance and see. 6,800 12,900 3,000. But then we need to analyze whether it is favorable or what? Adverse. It is important we analyze whether it is favorable or adverse. You had budgeted to use 61,500 kgs, ended up using 59,800. Therefore, that is what? Favorable. You had budgeted to use 49,200 kgs. You ended up using 53,500. That will be adverse. And lastly, H, you had budgeted to use how much? 32,800. Ended up using 33,300. That will be what? Adverse. But then you add that. The adverse plus adverse minus your favorable 9,100, which you're going to say is what? Adverse. Which you're going to say is adverse. But now we've said where you have more than one type of quantity you are using, you can further calculate your mix variance and your yield variance to get your usage what? Variance. Okay, so we will write here alternatively. Write this nicely for you. Alternatively, your material, the material usage variance can further be calculated as your material mix variance plus your material yield or material quantity variance. Okay, where your material mix variance MMV, you will say it is a standard price, actual quantity in standard mix minus actual quantity in actual mix. Actual quantity in actual mix. It is the actual quantity in actual mix. Okay, let's have these materials F, G and H. Your standard price is 4, 3 and 6. Your actual quantity consumed, remember, consumed or used 59.8, 53.5 and 33.3. 59.8, 53.500 and lastly 33.300. So that the total kgs that resulted in you producing 4,100 units will be 146,600. Okay. Your standard mix basically it is a ratio of how you are using your kgs to produce a single unit, to produce output, and you are using 15 kgs per unit, 12 kgs per unit of G and 8 kgs per unit of H. So your standard mix will be in the ratio of 15, 12 and what? 8, so that your total kgs to produce a single unit will be 35 what? Kgs, 35 kgs. Okay. Our actual quantity in standard mix simply means you share this actual quantity using the ratio of your standard mix. How is that going to be? You're going to take 15 over 35 times 146, 600. 12 over 35 times 146, 600. 8 over 35 times 146, 600. So what have you done? You have shared your actual quantity using the ratio of standard mix so that you get your actual quantity in standard mix. Your actual quantity in standard what? Mix. This will be 62,828.57. Can round that off. Then your actual quantity in actual mix is simply another name for actual quantity. So the actual quantity in actual mix is simply your actual quantity. Can we now get our variance? Yes, we can. Let's get our material mix variance. Okay. Your standard price is 4 shillings into bracket 4 shillings into bracket. Your standard, your actual quantity in standard mix is 62,828.57 minus your actual quantity in actual mix, which is 59,800. 59,800. 12, 100 and what? 14.285. We can say 0.29. Can round off to 2 decimal places and say 0.29, which we are going to say is what? 0.286, which we're going to say is what? Favorable. That is favorable. That is favorable. Again here, we get our actual quantity in standard mix here by taking the standard mix divided by the total standard mix times 146,600. $262.86 or 857. Your standard price is 3. Standard actual quantity in standard mix 50. 262.86 minus your actual quantity in actual mix 53,500. $97.11.429, which is going to be what? Adverse. So this is adverse. 33,508.571 is the actual quantity in standard mix. Your standard price is 6. 33,508.57 minus an actual quantity of 33,300. 12, 51 point what? 429, which is favorable, which will be favorable there. We add the variances together if they are similar. .28 what? 6, which will be favorable. Right. Okay. That is your material mix what? Variance. Let's get our material quantity variance. Which is your standard price, standard quantity in standard mix minus actual quantity in standard mix. In standard mix, can start with F. Your standard price was 4. Your standard quantity in standard mix simply represents your standard quantity. And your standard quantity, we calculated it here. The first working when we are getting our usage variance 61,500 minus your actual quantity in standard mix, which we've just calculated 62,828.57. Let's confirm that. 53, 14.286, which will be favorable, adverse, not favorable, adverse. You've used more quantity of raw material F, that is 3. Your standard quantity is 49,200 minus actual quantity in standard mix 50 to 62.86, 3188.571. That will also be adverse. FGH 6, your standard quantity minus 0.57. $4251.429. We need to identify whether it is favorable or adverse, and this will be an adverse variance. That will be an adverse variance. $12,754.286, which is what? Adverse, which is who? Adverse. Okay. Let's calculate our what? Alternatively, we can even get our material yield variance, which is your standard material cost per unit. That is given, SMC means your standard material cost per unit. Your budgeted quantity minus actual quantity that was done what? Produced. So this is a quantity of production, not of material used, of the quantity of production. Actually, this should be your standard yield, not actual quantity. Standard yield minus actual yield produced, that way. So just that, sorry. Standard yield minus actual yield. Now we have to calculate our standard material cost per unit. Our standard material cost per unit is here, 60, that is 648, which is how much? 144. 144. Then we need to determine our standard yield. So let's determine our standard yield. Computation of standard yield. Now, for us to produce 1 unit of who? Of our finished product, we are using how many kgs? 35. If we produced 4,500 units, how much quantity should we have done what? Produced. So we first identify the kgs we should have used for our production, for our budgeted what? Production. Keeping in mind that you are using how many kgs? 35 per unit. That means you used 157, 500 what? Kgs. But when you actually used how much? Your actual kgs here that you used to produce your total output was how much? Was 146,600. So just that. Let's say that 4,500 units you used to 157,500 what? Kgs. With 146,600 kgs, how much should have been your what? Output? how much should have been your output. 41.88571. Therefore, your material yield variance, you're going to say your cost per unit of 144, your standard yield per unit minus an actual yield of 4100. Your actual yield is your actual output. Your actual yield is your actual output. 12,754.286. You had budgeted to produce 4188 units, ended up producing 4100. So your output has reduced. So that is going to be what? Adverse. That is going to be adverse. Now remember, your material yield variance and your material quantity variance should give you the same answer. Your yield variance and your quantity variance should give you the same answer. Let's confirm that that is indeed the case. Your quantity variance is 12,754.286, which is very similar to your yield variance there. So those should be equal. Those should be equal. Now let's get our material usage what? Variance. Therefore, your material usage variance, we've said it is a summation of your material mix variance, and your material mix variance is here, that is 654.286, which we know is what? Favorable, plus your material yield or quantity variance, which is how much? 12,754.286, which is what? Adverse. So that should give you 9100 what? Adverse. That should give you 9100 adverse. Please confirm that this usage variance here, this usage variance there, and that usage variance give you the same answer. Those two should give you the same what? Answer. 9100 adverse for both. Alright. Then let's determine our material what? Cost variance. Material cost variance. Let's write it here. Material cost variance, which we simply denote as MCV. Your material cost variance is the summation of your material price variance as your material usage variance. Your material price variance is here, 17,570 adverse plus 9100 who? Adverse, plus 9100 adverse. 26,670, which is what? Adverse. 26,670, which is adverse, and that is your material mix, your material yield, your material quantity, your material usage, and your material price variance, as well as your cost variance. So these are the advanced variances for who? For materials. Okay, those are the advanced variances for materials. Right.
We're done with part A and B. Let's move to part C of this question. Sunny Limited is analyzing two options on how to expand these operations. The following data relates to two options. So we have option A and option B. So we have fixed cost for option A, selling price per unit for option A and B, variable cost per unit for option A and B, the expected sales for option A and B. Then the next page reads, required Roman 1, contribution margin per unit, 3 marks. Roman 2, the break-even point for both options, 3 marks. Roman 3, the operating income under both options. Number 4, we have advise Sunny Limited on which option is more favorable. Advise Sunny Limited on which option is more favorable. That is the question. So we are first of all to contribute the contribution. Part A of the question reads contribution margin per unit. Contribution margin per unit. This is part C. Contribution margin per unit. That is Roman 1. So we can have this thing in a table. We have contribution margin per unit. We can have the formula there. Contribution margin. There are two ways of answering this. I'm thinking of a better way that instead of just answering it straight away, you can have it. You can have this solution in form of a table. You can have it in form of a table. So we have the requirement here. For example, here we have contribution margin per unit. What is the formula? The formula of contribution margin per unit is selling price per unit minus variable cost per unit. That is the formula. So we have contribution margin for product A. Product A. Is it product A? Option A. It's called option A. Option A. And there is option A, option B. Selling price per unit. Contribution margin ratio is equal to selling price per unit minus variable cost per unit. For option A, the selling price is 150. The variable cost for option A is 90 shillings. And therefore, the contribution margin per unit is 60 shillings. Option B, the selling price per unit is 150 shillings. Variable cost per unit is 75 shillings. So 75 deducted from 150, this is equal to 75 shillings. Then Roman 2, what is required for Roman 2? Roman 2, we are to calculate the break-even point for both options in units. Okay. So break-even point in units. This is break-even point in units. The break-even point in units we know is equal to the fixed cost over contribution. Fixed cost over contribution margin. That is the formula for the break-even point in units. So from the question we read, option A, fixed cost is 200,000 shillings. This is 200,000 shillings. We divide by the contribution margin, which we calculated here, is 60. So I'll get my machine. 300,000 divided by 60. 200,000 divided by 60. This is equal to 3,333. 3,333 units. Let's do the break-even point for option B. The break-even point for option B, the fixed cost option B is 280,000. 280,000 divided by the contribution here is 75. So I take my machine again and punch in 280,000 divide 75. So I'm getting here 3,000. This is 3,733 units. To break even, option A requires 3,333 units to break even. Break even is a point where profit is zero. So option A will break even when 3,333 units are produced. Option B will break even when 3,733 units are produced. Then Roman 3, the operating income under both options. Look at Roman 3, operating income. 3, operating, the operating income, how do we calculate the operating income? Look at the question. What information do we have? We have expected sales. So our operating income, we will determine it by using the expected sales. We'll multiply the contribution margin per unit times the expected sales, then we deduct the fixed costs. So the formula for operating income will be the contribution margin per unit times the expected sales, deduct fixed costs. This is contribution margin per unit times the expected sales. We have the expected sales in units. The expected sales we have from the question in units. We deduct the fixed cost. So the contribution for option A, we have it here. This is 60 shillings times expected sales. From the question, expected sales is 6,000 units. The company is expected to sell 6,000 units. This will give us the contribution. Then we deduct the fixed cost for the option A, which is 200,000. 200. How much is it? This is 60 times 6,000. 200,000. This gives me how much? 60 times 6,000. This gives me, how much is this? The expected sales is 6,000. So let me take it again. 60 times 6,000. What is the fixed cost? The fixed cost is 200,000. The fixed cost is 200,000. Fixed cost is 200,000, which is equal to, this gives me 160,000. That is the operating income for option A. For option B, the contribution is 75. The company is expected to sell again 6,000 units. That is the total contribution. We deduct fixed cost of 280,000. So I have 75 times 6,000 minus 280,000. So this is equal to 170. Operating income, option A, 160,000. Option B, 170,000. I'm moving on well. Are you following, candidates? You need to memorize the formula. For you to be able to answer such a question, you have to have this formula in your head. Formula for contribution margin, formula for break-even point, is a formula for operating income. Operating income, we take the contribution margin per unit, we multiply by the number of units. For option A, 6,000, option B 6,000, you get the total, then you deduct this cost to arrive at the operating income. Then what else is required from this question? Roman 4, advise the company on which option is more favorable and why. Definitely option B is more favorable. Number 4, option B is more favorable because it has, or it promises, a higher operating income of shillings 170,000. You see, this one is higher than the 160,000 because companies are in business to make more income. If option A promises 170,000 shillings, option B promises 160,000 shillings, it's better to take the one that promises a higher operating income. So that is it, candidates, for today's lesson, in which you have answered the question that was tested in August 2025, question 4. We will continue to provide more solutions to these questions. If you have any queries, feel free to ask your questions, and all your questions will be answered. Bye-bye.
Now, you can look at a similar question, the previous question. You can look at a previous question. It has been tested just a few semesters back. Let's go to September 2021. September 2021. September 2021. Question who? 5B. September 2021. Question 5B. The question is saying the standard cost of certain chemical mixture is 40% material A at 20 per kg, 60% material B at 30 per kg. The standard loss of 10% is expected during production. During the month of July, the actual data was as follows. Material A used 90 kgs at a cost of 18 per kg. Material B used 110 kgs at a cost of 34. The weight produced was 182 kgs of good production. Let's start by getting our material mix, our material price variance. Our material price variance, you say it is your actual quantity, standard price minus actual price, Your actual quantity, you have two types of materials, A and who? B. The actual quantity you purchased was 90 kgs. The standard price per kg was 20 minus an actual price of 18. For material B, your actual quantity was 110. Standard price per kg was 30 and your actual price per kg was 34. 30 minus 34. This must be 180. That must be 400 and what? 40. The standard or the material price variance here for A, you had budgeted to buy at 20, But instead of buying at 20, you bought at what? 18. So that's good. So that is what? Favorable. B, you had budgeted to buy at 30, ended up buying at 34. So that is also what? That is adverse because you've spent an extra amount. Then you confirm what kind of variance this is, and this is 250, which is what? Adverse. 260, which is adverse. That is your material price variance. Let's get our material mix variance. And how do you get your material mix variance? You say it is your standard price, your actual quantity in standard mix minus your actual quantity in actual mix. Standard price, actual quantity in standard mix minus actual quantity in actual mix. And actual is standard price P. The standard price of A is 20, B is 30. Your actual quantity that was used is 90 for A and 110 for B. Your standard mix, the ratio of how you are using your materials is 40 is to 60. That is 200. That is 100. Therefore, actual quantity in standard mix. You simply share the actual quantity using the ratio of your standard mix, using the ratio of your standard mix. And how will that be? This will be 40 over 100 times 200, 60 over 100 times 200. That is 80, and that is what? 120. Alright, your actual quantity in actual means we said, in actual mix we said is your actual quantity. So let's get your material mix variance here. Your standard price is 20. Actual quantity in standard mix is 80. Minus an actual quantity of 90. 100. Standard price of 30. Actual quantity in standard mix of 120. Actual quantity in actual mix of 110. This will be adverse, favorable. So that in total, that will be 100 favorable. Okay. The next item they are asking us to determine is your material yield what? Variance. Material yield variance. You said, how do you get that? You simply take your standard material cost per unit into bracket your standard yield minus your actual yield. Standard yield minus actual yield. Let's determine our standard material cost per unit. They were saying there that the standard cost of material of a certain chemical, 40% of material B was bought at 20, 60% of material B was bought at 30. So therefore, your material cost per unit, you're going to take those percentages times the price of each. Which will be 26. That should give you 26. Let's determine our standard yield. Then now need to determine our standard yield. Now they were saying the standard cost of a certain chemical mixture is 40 and 60, and a standard loss of how much? 10% is expected during what? Production. Okay, so this is what we do here. We first identify the input materials that were introduced and the output that was done what? Produced. Okay, and here with an 100% input of materials, with an 100% input of materials, your output was 90%. Your output was what? 90%. Why? Because of a standard loss of 10%. 10%. Okay. If you introduce 200, this can ignore this percentage here, that way. If you introduce 200, how much should have been your standard yield there? Your standard yield should have been 180 units. If you are to use the material in the same way you are using according to what you budgeted, you should have produced 180 units. So your yield variance will be 26, 180 minus an actual yield of 182. Your actual yield is 182. This is 52, which we are going to say is what? This is an output. This is output. So yield means output. So we are going to say it is what? Favorable. Favorable. Okay. Your material usage variance, it's going to be your material mix variance plus your material yield variance. Plus your material yield variance. Your mix variance is 100 favorable. Your yield variance is 52 favorable. So that is 162 what? Favorable. Let's determine our material cost variance, which is your material price plus your material usage variance. Your price variance is 260 adverse plus 162 what? Favorable, which means that is 98 what? Adverse. 98 adverse. And that is how you determine your what? Your advanced variances of who? Of material. Those are the advanced variances of what? Material. All right. Now that we have understood the advanced variances of material, we also should look at the advanced variances of labor, the advanced variances of fixed overheads, and also the advanced variances of sales revenue. Okay. All right. I hope that has been clearly understood. That has been clearly understood. That has been clearly understood. Right. Now, when we meet in the next lesson, we will introduce the advanced variances of what? Labor. We will introduce the advanced variances of labor, which will be in the next lesson. So from me, you can attempt a question, to give you a question that you can attempt in your own free time. You can look at August 2022 question 5B as an assignment, just for your practice. Your assignment. Please look at this question for your own practice. August 2022 Question 5b. Question 5b. There is a variance of what? It is an advanced variance of materials. All right. So allow me, and on behalf of the institution or on behalf of Manifested Publishers, we can call it a day. See you next time when we will tackle labor variances and overhead variances and sales variances that are advanced in nature. So goodbye and God bless you. See you next time.
I'm glad to welcome you to the Manifested eLearning platform once again. We continue with the subject finance for decision making. The topic is budgeting and budgetary control. We are in our today's lesson going to consider the last subtopic, which is cost, volume, profit analysis, which is a crucial tool in management accounting that is used to study the relationship between costs, sales volume, and profit. Three elements: costs, sales volume, and profit. The CVP analysis studies the relationship between costs, sales volume, and profit. And this analysis helps managers make informed decisions by assessing how changes in one variable impact the others. How changes in the sales volume will impact the profit. How changes in profit will impact the cost. How changes in cost will impact the volume, and so on. So in this lesson, we study the key components of CVP analysis. We will study the assumptions of CVP analysis and the CVP calculations, three things. So we begin with the components. What are the components of CVP analysis? Components. Now, the first component of CVP analysis, the first component is selling price. Selling price. If you're in business of buying and selling, your products must bear a selling price. And here we are referring to the selling price per unit at which a product or service is sold. That is the selling price. So the first component of the CVP analysis is selling price. Then the second one is sales volume. Sales volume refers to the number of units sold. If you are doing a business, if you are running a company, if you are in business of buying and selling goods or manufacturing and selling goods, then within a specified period of time of, say, the accounting period, you may sell given number of units. So that's what we are referring to as sales volume, the quantity of units that are sold within a specific period of time. Then the third element is what we call variable costs. Variable costs are costs that change in direct proportion to changes in sales volume. There are certain costs that will change when you change the sales volume. Examples of such costs include direct material, direct labor, direct expenses. When you are selling or manufacturing or producing goods or services, there are costs that will change as you increase the volume. They may also change as you decrease the volume. We are referring to them as variable costs. They vary as the sales quantities change. Where the quantities increase, these costs increase. Where the quantities reduce, these costs reduce. A good example is just the material, say raw materials. If you are producing, say, loaves of bread, you require, say, 10,000 shillings as a cost of producing a product. So if you reduce the number of products, then that cost of raw materials is most likely to reduce, and vice versa. So the third element of CVP analysis is variable cost. Then we have what we call fixed costs. These are costs that remain constant regardless of changes in the sales volume. Like if you have premises, you pay rent per month of 100,000 shillings. That rent will be paid whether you are selling more units or selling few units. So there are costs that don't change with the change in the sales volume. Another example is salaries. If you have salaries of say 500,000 per month, you have staff that you are paying 500,000 per month and it is fixed at that. It does not matter whether the sales are increasing or reducing. That amount has to be paid whether the company is selling or not. So fixed costs are costs that do not change with the change in the level of production. Then the last component is profit. Profit. This is the total revenue minus total costs. And total costs here include the fixed costs and the variable costs. So total profit will be equal to, this is equal to total revenue minus total cost. That you get your profit. And we call it operating income. It may also be referred to as operating income. So these are the main components. These are the key components of CVP analysis. Selling price, sales volume, variable costs, fixed costs, profit. Now let's move to the second part of this lesson, which is the assumptions. What are the assumptions of CVP analysis? What are the assumptions of CVP analysis? Now, CVP analysis is based on several simplifying assumptions. And the first assumption is that the costs are linear. Costs are linear. That's assumption number one. Costs are linear. What does that mean? That means that costs behave in a linear fashion throughout the relevant range of activity. Costs are linear. That's assumption number one. Assumption number two is that the selling price is constant. It is assumed that selling price is constant. Selling price is constant throughout the period of analysis. Selling price is assumed does not change. The selling price per unit does not change during that period of analysis. That's the second assumption. Third assumption, all production is sold. All products are sold. All products within that period are sold. When carrying out this analysis, we make the assumption that all the products that are produced in a year or in that period are sold. That means that inventory levels do not change, meaning that production equals sales. All that is produced is sold. That is the assumption. All products are sold. You understand? Yes. Inventory levels do not change, meaning that whatever is produced, all the units that are produced are sold. 4, sales mix is constant. This is the assumption that sales mix is constant. That is for multi-product companies. If a company sells multiple products, the relative proportion of each product sold remains the same. Then lastly, efficiency is constant. This is the assumption that efficiency constant. For CVP to be valid, then it has to be assumed that efficiency is constant, meaning that productivity and efficiency remain unchanged. Efficiency does not change. So these are 5 key assumptions of the CVP analysis or the CPV analysis, cost volume profit analysis. Cost volume profit analysis. Now let's move to the CVP calculations. The third part of this lesson is analysis calculations. Now, candidates, the CVP model uses several key metrics to analyze profit. And the first one is contribution margin. Contribution margin. Number 1 is what we call contribution margin. Contribution margin is the revenue remaining after deducting variable costs. Revenue remaining. That means that contribution margin is equal to selling price minus variable costs. So contribution is equal to selling price per unit minus variable cost per unit. It represents the amount each unit sale contributes towards covering fixed costs and generating profit. And from this contribution margin, we get what we call contribution margin ratio, okay, which we will give the formula in a short while. But the fundamental profit equation in CVP analysis equal to selling price per unit times the volume, the number of units sold. This will give us the revenue. From this revenue, we deduct the variable costs, and the variable cost will be equal to the variable cost per unit times the number of units produced. Then we deduct the fixed cost. So this is the fundamental function of the profit equation or profit. To get the profit, we have to multiply the selling price per unit times the number of units produced, which are represented by V, volume, minus the variable cost per unit times the same number of units. Then we deduct the total fixed cost. That will give us the profit equation. Then number 3, we have what we call the break-even point. Break-even point, BEP. Now the break-even point is the level of sales volume at which total revenue exactly equals total cost. At break-even point, total revenue equals total cost. And at this point, profit is 0. Because if your total revenue is, say, 100,000 and your total cost is 100,000, then your profit will be equal to the total revenue minus total cost, which is equal to 0. So at break-even point, the profit is equal to 0. 0 profit. To get 0 profit, then the total revenue will equal the total cost. And this break-even point can be determined either in shillings or in units. Break-even point in units will be equal to total fixed cost minus contribution margin. This is the formula for determining the break-even point in units. That means the number of units that may be produced, the profit will equal 0. Break-even point number 2 may also be determined in shillings. Break-even point in shillings will be equal to the total fixed cost over contribution margin ratio. Break-even point in shillings will equal to the total fixed cost over contribution margin ratio, where contribution margin ratio is equal to the selling price per unit minus fixed cost per unit divided by the selling price per unit. This will give us a contribution margin ratio. It has to be 0 point something, because be more than the numerator. It has to be 0 point something. It's a ratio. So this is how to determine the contribution margin. The break-even point in shillings equal to the total fixed cost divided by the contribution margin ratio, which is equal to the selling price minus fixed cost over selling price. Because we saw here that contribution is equal to selling price. This is contribution. It's equal to the selling price per unit minus fixed cost per unit, which is equal to here selling price per unit. So to have it as a ratio, you divide by the selling price per unit. So that is number 3, break-even point. Then we may have number 4, what the target profit analysis. Target profit analysis. Now this calculation determines the sales volume required to achieve a specific level of target profit. If you have a target profit of say 1 million, the question is, how many number of units do you need to produce to earn the target profit of 1 million? That can be determined in advance. And managers use such analysis to predict or to analyze the level of probability that they desire. And that can also be calculated either in units or in target profit or target sales units. The number 1, target units will be equal to the total fixed cost plus the target profit divided by contribution margin. This will be contribution margin per unit. To get the target sales units, we take the total fixed cost, we add the target profit, then we divide by the contribution margin per unit. Target profit sales can also be determined in shillings. Number 2, target sales in shillings will be equal to the total fixed cost plus the target profit we divide by the contribution margin ratio. Divide by the contribution margin ratio. So target sales in shillings is equal to the total fixed cost plus the target profit, we divide the contribution margin ratio. So these are the formulas we may use in CVP analysis. You have the contribution margin, which is equal to selling price minus fixed cost. You have the profit equation, which is equal to the selling price per unit times the number of units minus fixed cost per unit times the number of units minus fixed cost. Then number 3, we have the break-even point. At break-even point, we've said profit is 0, which is equal to total revenue minus the total cost. It is at break-even point that the total revenue will equal the total cost. Then we can determine this break-even point either in shillings or in units. To get the break-even point in units, we take the total fixed cost divided by the contribution per unit. Then break-even point in shillings will be equal to the total fixed cost divided by the contribution margin ratio, where contribution margin ratio is equal to the selling price per unit minus fixed cost per unit divided by selling price per unit. Then we have the target profit analysis, which we can determine the target sales unit or the target sales. Yes. So these are the formulas that we may use in the cost, volume, profit analysis. Now let's, in closing this lesson, discuss number 4, uses of CVP or importance or uses of CVP analysis. Managers use CVP analysis for various decision-making purposes. One such purpose is pricing decisions. CVP analysis may be used in pricing decisions, making decisions regarding prices. Making decisions regarding prices. Pricing decisions. Okay? Determining the minimum price required to cover all the costs. CVP analysis can be used by managers to determine that price that can be set which covers all the costs and also which promises profit. Because selling price must include an element of profit. Because we know that selling price of a product or a good is equal to the cost. If you want to get profit, then the selling price must be more than the cost of the product that you are selling. So CVP may be used in pricing decisions. It can also be used in product planning. Product planning. We use CVP analysis in planning products, product planning, deciding whether to introduce a new product or to drop an existing one. We may rely on CVP analysis. 3, we can use CVP analysis in cost structure management. That means evaluating the trade-off between fixed costs and variable costs. Okay? And we can substitute fixed costs with automation and variable costs with labor and so on. Sales mix decisions. Sales mix decisions. That means optimizing the mix of products sold to maximize the overall contribution margin ratio. What mix? Do we sell product A and B and C? Do we sell product A, we omit B and sell C? Do we sell product A, E, F? So that mix, the sales mix can be made possible by relying on CVP analysis, because then the company can be able to determine which products generates high contribution, sales mix decisions. Another use is budgeting. CVP analysis can be used in budgeting. That means selling or setting targets and projecting financial results. We can use CVP analysis to set certain sales targets and to project financial results. Then lastly, we have what we call margin of safety. Very important use of CVP. Margin of safety means assessing the risk of determining how much sales can drop before the company reaches the break-even point. So these are 5+1 uses of CVP analysis. And that will mark the end of our today's lesson. In our next session, we are going to get into the calculations. We are going to answer past paper questions that have been tested to see how we can apply these formulas. So please, when you come into our next session, make sure you have a calculator ready to do the calculations. Go through the videos, memorize the formula. When we meet in our next session, we are going to work out past paper questions from the KASNEB. Bye-bye. I greet you all and welcome you back to the governance and compliance audit lesson. Today, our focus is on the governance and compliance audit checklist, which is a practical tool used in the planning phase to ensure that all critical aspects of the audit are considered and addressed. So there has to be, at the planning stage, a checklist which acts as a summary of the planning process, and it provides a final check to confirm that the audit is ready for execution. In this lesson, we are going to break down the key planning phases that are covered in a checklist. And the first one is the initial consideration and scope. Initial and scope. All right. Initial consideration and scope may cover areas like the audit purpose and objectives. The checklist must answer questions like whether the audit objectives have been clearly defined. Have the audit objectives been clearly defined? The objective could be to assess compliance with the data protection laws or to evaluate board oversight and so on. Another question here at this point is the audit, if the audit has been approved by the appropriate authority. Has the audit been approved by the appropriate authority? And the appropriate authority could be the audit committee, it could be senior management. So one aspect of the checklist is the audit purpose and objectives. Then there is audit scope. Audit scope. Is the audit scope clearly defined, including the specific business units, the processes, systems that are to be audited? And have any exclusions or limitations to the scope been clearly stated and agreed upon? Has the time period to be audited been specified? So those are aspects of the audit scope which have to be covered in the checklist. So there has to be that part of the checklist which has to be ticked as the planning phase comes to an end. Then you have understanding the entity. Understanding the entity. Here questions to answer are, have we reviewed the entity's organization structure and key business processes? Another question is, have we identified the relevant industry and legal regulatory requirement? Have we gained an understanding of the entity's risk management and internal control frameworks? So that is very important. At the initial consideration scope, part of the checklist should be this, answering these three questions. Then the second part, the second aspect is our phase. So this is just phase one. Then phase two, we have risk assessment and strategy. Assessment. Now here, we are talking about the risk assessment. Risk, number one, is risk assessment. What questions should be answered here? One, have we conducted a preliminary risk assessment to identify high-risk areas of non-compliance? Number two, have we identified the inherent and control risks for the key audit areas? Then there is also the aspect of materiality. After dealing with risk assessment, there is a materiality, particularly the thresholds. Have we determined the quantity, the quantitative and the qualitative materiality thresholds for the audit, e.g., the specific legal violation is always material and so on. Then three is assurance level. Assurance levels. have we determined the level of assurance to be provided? Is it reasonable level of assurance? Is it limited level of assurance? Is it agreed upon procedures? And does the chosen assurance level meet the expectations of the key stakeholders? That is the assurance level. Then there is, of course, the audit strategy. Audit. Now, audit strategy candidates, we have to check whether there has been an overall audit strategy. Has an overall audit strategy been developed and documented? Has the audit team been assembled with the necessary skills and expertise? Have the threats to audit been identified, and has a plan for safeguards been developed? So that's part of the second phase. Then the checklist for the third phase is the detailed planning and documentation. Detailed and documentation. Detailed planning and documentation. Here we are dealing with the subject matter and criteria, for example. Subject and criteria. Subject matter and criteria. Have the question to answer is, or what to check is, if there has been specific subject matter, what is being audited, that is the subject matter, and the criteria, which is the benchmark. Have these two been clearly defined? Another question is, have we prepared a governance and compliance matrix linking requirements to controls and audit procedures? 2, audit plan and program. Currently, we are discussing the checklist, which you have defined as a summary of the planning process, right? Which provides a final check to confirm that the audit is ready for execution. Now, the questions to answer in relation to audit plan and program is that 1, is the final audit plan drafted and approved? Has it been approved? Number 2, is the detailed audit program complete with specific step-by-step audit procedures? Number 3, does the program specify the evidence required for each procedure? Then, of course, we have the resource allocation. There is the aspect of resource, let me call it resource management. Resource management and logistics. Have the necessary resources like personnel, budget, and technology been allocated? Number 2, have we established realistic timeline with key milestones for the audit? Number 3, have we planned for access to key systems, documents, and personnel? So this is phase number 3. There has to be a checklist for subject matter and criteria, audit plan and also program, then resource management and logistics. Let's move to the 4th phase. Now, the 4th phase is the final preparations. There has to be checklist on final preparations. Having dealt with the detailed planning and documentation, there is also final preparations like issues to do with the working papers, communication. You have working papers. There is issues to do with communication. Now, the question to answer on working papers, for example, it would be, have the permanent and current files been set up? Have they been set up? The permanent file, has it been set up? The current file, has it been set up? Number 2, have all planning documents been properly documented and indexed in the working papers? Then there are also questions to answer on communication. Has a kickoff meeting, for example, with the audited department been scheduled? Has a formal communication plan been established to keep the stakeholders informed throughout the audit? There could also be questions to answer on review. On the final preparation, we have the working papers, communication, and also review. And let me put it together with approval. Review and approval. All right? For example, has the entire audit plan been reviewed by senior member of the audit team? Has the final audit plan been formally approved before fieldwork begins? So those are questions that are to be answered when preparing the checklist before the audit commences. There has to be a checklist, candidates, which is a practical tool that is used in the planning phase to ensure that all the critical aspects of the audit are considered and addressed. So before getting into the fieldwork, there has to be a checklist, and all the questions that we'll be discussing are addressed so that nothing is left to chance, so that there are no omissions when the audit commences. So using such a checklist ensures that the audit team has considered all the critical elements of the planning phase, setting the stage for a thorough, effective, and well-documented audit engagement. So that's all for the governance and compliance checklist. I'll meet you in our next session where we continue to learn more on governance and compliance audit. Bye-bye. December 2024 past paper on finance for decision making, question 2C reads as follows. The following information relates to Uzima Limited for the 4 months given below. So you have the sales for September, October, November, and December. All sales will be made on credit. Half of the debtors are expected to pay within the month of sale and are also expected to claim 8% cash discount. The remaining debtors are expected to pay by the beginning of the following month. Then below that statement we have raw material purchases for September, October, November, and December. The firm plans to pay its creditors in full in the month following that of purchase. Then below that statement we have the wages and salaries for September, October, November, and December. Part 2 or page 2, we have additional information on page 2. Additional information number 1 reads, all employees are paid in the month in which the wages or salaries is earned. Number 2, rent of 40,000 for each quarter is paid in the month of March, June, September, and December. 3, other cash overheads of 8,000 shillings per month are payable. 4, a new plant due for delivery in September will be paid in November at a cost of 100,000 shillings. 5, on 1st October, the firm plans to have 40,000 shillings in the bank. That is on 1st of October. On 1st of October. Required, a cash budget for the month of October, November, and December. October, November, and December. So that is the question. We are to prepare a cash budget for the month of October, November, and December. So that is it. Part C. We are to prepare a budget, a cash budget. The company is known as Uzima Limited. Cash budget for the month. You have to have a title for the month. For the months, there are months. For the month of October, November, and December. That is the title. Now remember we said that a cash budget comprises of 2 main components, receipts and disbursements. cash inflows and cash outflows. Cash inflows and cash outflows. So from the information given, we need to identify the receipts and payments for the month of October, November, and December. So we have October, November, and December. So here we have December. We'll have 3 columns for the amounts, November and October. These are shillings. Are they in thousands? No, they're just shillings. So candidates have said that a cash budget will contain mainly the disbursements, which are cash outflows or receipts, and the receipts and cash disbursements. But again, there could also be balances. In this question we read that there will be a balance. The company intends, we read that the company intends to have a cash balance of 40,000 on October 1st. So we will have, first of all, a row for cash balance. This is cash balance brought down. At the beginning, we've seen for the month of October, the company expects to have 40,000 shillings. Then we have the receipts. We need to identify the sources of these receipts. Now from the question, we have cash sales, that is the first source. Then we have collections from debtors. Look at the question. Those are the main receipts. Cash sales, we have cash sales. Then the second receipt is cash from debtors. Cash collections from debtors. Cash from this question, those are the only 2 receipts. Then you have disbursements or payments. Payments. What payments? The first payment here will be the credit purchases. Credit purchases. Payments will be made to the creditors. Credit purchases. The second payment will be, from the question we see, wages and salaries. Then we have rent. Rent is a payment. We have cash overheads. Cash overheads. Overheads are indirect expenses. Then do we have any other? Yes, we read that the company will pay for delivery of a new plant. That is a payment. This is new. Plant is expected to be paid in November. That we can just have it in November. Here we have 100,000 will be paid in November. New plant. Then I don't think there is anything else. There is no payment. So we'll have here total payment. Total payment. We have total payment. That is a row for total payment. Then receipts. There is also total cash receipts. We have here a total receipts. So we have balance at the beginning. We add cash sales. We add cash from debtors. We are going to have the total receipts for each month. Then out of these total receipts, we are going to deduct the payments, which include the credit purchases, wages and salaries, rent, cash overheads, new plant. So we'll have the total payments. So we deduct the total payments for each month from the total receipts. When we deduct total payments from total receipts, we are going to have cash balance at the end of the month. This is cash balance at the beginning. So cash cash balance at the end is known as balance carried down. This is balance brought down. At the end we call it balance carried down. So these are the columns that we are going to have for October, November and December, and these are the rows which we have obtained from the question. So the balance at the beginning of the month of October, we have it from the question. Then we need to have a working for cash sales. That will be our working number 1. So we will have workings over here. So working 1 is cash sales. And what information do we have on cash sales? We read from the question that half of the debtors are expected to pay within the month of sale and are also expected to claim 8%. So you'll have a working here for cash sales. We start with the October. The cash sale for October will be half of the debtors. Half of the debtors. So half of the debtors for October, we have a half of the amount for debtors for October is 240. We multiply by 240,000. This gives us the half the amount. But we read from the question that and are also expected to claim 8% cash discount. So the company is expected to claim 8% discount. Okay, 8% discount. Debtors are to pay, but there is 8% discount, which means the 200 and half of 240 will not be received 100%, but will be 100% minus 8%, which is 92%. So we are going to multiply this figure by 92%. The same case for November. Half will be paid. Half of the amount for November from the question is 280. 280,000 times 92%. December, half of the amount there is 360 times 360,000 multiplied by 92%. So the rest is the work of the calculator. Calculator, we go to the calculator. Calculator, let me pick my calculator. Yes, I have it here. So we have a half of 240, that will be 120. So 120,000 times 92%, 0.92. 110, 400. Then a half of 280, this is 140,000. 140,000 times 0.92. 128, 800. December, 360, half of 360, this is 180. 180,000 times 0.92. 165, 600. So this is the cash sales for October. 110, 400. November, 128, 800. December, 165, 600. That is working 1, cash sales. Then what do we read? The cash collections from debtors, we read that the remaining debtors are expected to pay by the beginning of the following month. Or to pay the beginning of the following month. That means that the sales credit for September will be due in October, half of it. So this is cash collection from debtors. Cash collection from debtors. So number 2, the second working is cash collection debtors. Cash collection from debtors, read from the question that the remaining debtors are expected to pay by the beginning of the following month. That means that the September credit sales will be due in October. September in October. So September sales will be is 240 September sales, and half of that, half of 240,000 will be due in October. So half of 240 is equal to 120,000. So that is October. The September sales will be due in October. October sales will be due in November. October sales will be due in November. The October sales again, October sales is 240. So half of 240 will be due in November, which is equal to 120,000. And lastly, November sales will be due in December. November sales is 280. November sales is 280. 280, half of 280 will be due in December. Half of 280 is equal to 140,000. So these are cash collections from debtors. For the month of October, how much will be received? The amount that will be received in October is half of what was to be received in September, which is equal to 120 as calculated. Cash from debtors for the month of November is half of the sales that were to be received in October, which is equal to again 120. December 140. So these are the receipts. So we are going to sum the receipts. We begin with the October receipts. October receipts. October receipts. October receipts. October receipts. We have the balance at the beginning of 40,000. Add 110. 400. Add 120,000. Equal to 270, 400. We go to the expenses. We move to expenses. One source of expense there is credit purchases. Credit purchases from the question, we see that we read that the firm pays its creditors in full in the following month. In the following month of purchase, the following month, the firm pays its creditors the following month, which means September purchases are paid in October, October purchases are paid in November, November purchases are paid in December. So we have the purchases, and the September purchases are paid in October. What is the amount for September purchases? September purchases is 80,000 is paid in October. So the credit purchases that will be paid in October are September purchases, which 80,000. Then we have the October purchases that will be paid in November. amounting to 160,000. November purchases will be paid in December. November purchases will be paid in December. November purchases amount to 160,000. Then of course we have wages and salaries from the question. Wages for October is 60,000. 60,000 October wages. Then November wages 68,000. December wages, we are reading from the question, directly from the question. These ones we are picking directly from the question. We do not require workings. The wages and salaries for December is 52,000. Then of course we have rent, which we see will be paid. The rent amounts to 40,000. The rent amounts to 40,000, and we read that from the question, rent. That is which note? Rent. Let's move to page 2. Note 2 reads, rent of 40,000 for each quarter is paid in the month of March, June, September, and December. So for the last quarter, this is the last quarter, we have a rent of 40,000 which is paid in December. So the rent here is paid in December. It's very clear from the question, direct. Then we have cash overheads. Cash overheads. Cash overheads. We have cash overheads. Yes. Cash overheads amount to 8,000. Cash overheads amount to 8,000 for each of the months. Cash overhead, we have 8,000, 8,000, 8,000. Then of course we have the new plant that is to be delivered in November of 100,000. So we can now do the totals. We have plugged in all the details. So first we begin with the month of October. We are going to do the cash balance, which will bring down to the month of November. We have the total of receipts in October. We need to get the total of purchases, the total of payments in October. We deduct the total payments from the total receipts to get the cash balance at the end of the month of October. So let's do the total payments. 80,000 plus 60,000 plus 8,000 is equal to 148,000. This is total payments for the month of October. We deduct this payment from the receipts to get the balance. So we deduct 148,000 from 270, 400. So the balance here is 122, 400. So this balance carried down at the end of October becomes the balance brought down the month of November, which is 122, 400. That is balance brought down. This balance brought down is going to form part of the receipts in the month of November. So we take the 122, 400, add 128, 800, 128, 800, add 120,000, 120,000. The total is 371, 200. That is total receipts for the month of November. We deduct the total payments from this total receipts. What's the total payment? The total payment is 160 plus 68 plus 8 plus 100,000. So total payments for the month of November, 160,000 plus 68,000 plus 8,000 plus 100,000. So I get here 336,000. 336,000 is the total receipts. Deduct from 371, 200, 371, 200. The balance carried down is equal to 35, 200. 35,200 is the balance carried down month of November. Balance carried down month of November becomes balance brought down month of December, which is 35,200. We are going to add here to get the receipts. 35,200 plus 165,600 plus 140,000. Total receipts month of December 340,800. We do again the total receipts, the payments for total payments for the month of December. So 160,000 plus 52,000 plus 40,000 plus 8,000. So I have 160,000 plus 52,000 plus 40,000 plus 8,000. Total 260. Is it 260? Yes, 260,000. We deduct from the 340 to get the balance at the end. And 340, 800. So balance here at the end is 80, 800. So look at the question again. Do you have anything that we have omitted? No. So that is the preparation of cash budget. We've answered the question that was tested in December 2024, question 2. When preparing the cash balance, the cash budget candidates, first of all, make sure you have the heading. That is the name of the company that is preparing the cash budget. So there are three main columns. There are two main columns. The two main sections. We have section for the receipts. We have section for payments. Then we have balance at the beginning. This balance at the beginning is given in the question. We begin with the balance at the start. We add the receipts for the month, deduct the payments for the month. Then we have the balance carried down at the end. The balance carried down at the end of the month, one month becomes the balance brought down the next month. We do the same process. We have a balance carried down at the end of this month, which is also brought down the next month. Then again, we deduct the cash payments from the total receipts. We get the balance carried down at the end of the last month. That's the end of our today's lesson. Thank you. We will answer more questions from past papers. If you go to the block revision segment on our website, we've done more questions. So make sure you go to the past papers, attempt the other questions, and you can also refer to the answers in our books. We have done this also in our revision books. The same answers are in video format on our platform, www.manifestedpublishers.com. Bye-bye. I'm glad to welcome you back to the lesson. Today we continue with the subject governance and compliance audit. Our focus today is on levels of assurance, determining the level of assurance, which is a very critical step in the planning phase of the governance and compliance audit, because it directly impacts the scope, the audit procedures, the amount of evidence required, and also the nature of the final report. And unlike the financial audits, where the standard is often reasonable assurance, governance and compliance audits may have more flexibility in the level of assurance that is sought. And the level of assurance candidates is just a measure of the confidence that the audit team provides to stakeholders regarding the subject matter. Assurance comes from the word assure, to assure. When the auditors examine the records, the objective is to provide assurance on the subject matter and its spectrum, not a binary choice, and it's not a binary choice, but it's just a professional judgment call based on the auditor's objectives, risks, and also stakeholder expectations. So when conducting a governance and compliance audit, just like the financial audits, the auditors are required to provide some level of assurance. And the levels of assurance may be categorized into three. One is the reasonable assurance. Number two is the limited assurance, and no assurance. That is what we are going to study in our today's lesson. Levels of assurance. There are generally three levels of assurance that can be provided in a governance and compliance audit. And the first level I've mentioned it, which is a reasonable assurance. A reasonable assurance is a high level assurance, okay? But it's not absolute assurance. And here, the auditor gathers sufficient appropriate evidence to conclude with a high degree of confidence. But that degree of confidence is not 100% certainty. Okay? But it is just, it indicates what we call materiality compliant with the criteria that is established. You understand? It is a high level assurance. A reasonable assurance is a high level assurance. And this level requires extensive and rigorous procedures. The audit team must perform detailed testing. It has to do what we call substantive procedures. It has to verify controls and compliance activities. And it often includes a combination of inquiries. The auditors have to make inquiries. The auditors have to inspect documents. They have to observe processes and also reperform procedures. You understand? For you to provide a high level assurance, for the auditor to provide a reasonable assurance, the auditor has to carry out substantive procedures. And the final report provides what we call a positive opinion. It provides a positive opinion that in the auditor's judgment, the organization's controls or compliance activities are effective and free from material non-compliance. The auditor can only give that opinion after conducting thorough investigation, after ensuring that he's done detailed testing, after the auditor has verified controls and compliance activities. It is only then that the auditor can give a high level assurance or a reasonable assurance. You understand? And this level candidate is chosen for high risk areas where non-compliance would have a severe impact. Examples could include audits required by law or regulation. It could be audits of critical financial controls or data security systems. Another example could be audits where there is a high potential for reputational damage or significant financial penalties. You understand? Yes, you need to understand, candidates, that when called upon to carry out a governance and compliance audit, as an auditor, you may be required at the end of the day to provide assurance to the stakeholders. And that assurance can be categorized into three: reasonable assurance, limited assurance, and no assurance. We've defined reasonable assurance as high level assurance, but it's not absolute assurance. We say that in a reasonable assurance, the auditor gathers sufficient appropriate evidence to conclude with a high degree of confidence that the subject matter is materially compliant. And we've given examples. It could be audits that are required by law, or audits of critical financial controls. It could be audits where there is a high potential for reputational damage. Then there is a second level of assurance, which is a limited assurance. On the other hand, what does it mean? This is a moderate or less reasonable assurance. It's a moderate assurance. And the auditor here has to perform fewer procedures and therefore provides a lower level of assurance because he has conducted fewer procedures. You understand? And the conclusion is often negative. Here we said the opinion or conclusion is positive. Here the conclusion or opinion is negative. What do we mean by negative? Negative. The opinion here is negative. It is a negative one, stating that based on the work performed, nothing has come to our attention. That is what the report will read in a limited assurance. Based on the work performed, nothing has come to our attention that causes us to believe there is a material non-compliance or significant control weakness. Okay? Nothing has come to our attention. That is being negative. Nothing has come to attention. Having carried out few procedures, nothing has come to our attention that causes us to believe that there is material, that there is a material non-compliance or significant control weakness. And unlike reasonable assurance, procedures are less, procedures are fewer, procedures are less extensive than a reasonable assurance engagement. And here the auditors often rely on inquiries. Okay? They do not carry out substantive procedures. They rely on inquiries, on just interviewing the personnel, carrying out analytical reviews, and so on. Okay? And high-level inspections rather than detailed testing of transactions or controls. And the focus is on plausibility rather than detailed verification. In limited assurance engagement, there is limited engagement. There is limited. It's limited. Okay? Testing is limited. And that's why the degree of assurance is low. And the final report provides a limited opinion, which is a less definitive statement than a positive one. It is not as definitive as a positive conclusion or a positive opinion. And this level of candidate is often used for areas of lower risk. If there are areas of lower risk of non-compliance, you apply this level of assurance. But if it is a high risk area, then you have to do substantive testing in order to come up with a reasonable assurance. Okay? Or when there is a quick or cost-effective review that is needed. It can also be good when starting. It can be a good, let me put it, it can also be a good starting point for a new audit area or an immature compliance program. And examples of limited assurance could be a review of an organization's, say, environmental and social activities. Okay? A review of an organization's maybe first-time environmental or social governance. Or just another example could be an initial assessment of a new business process or internal management requested reviews of routine operations. Is that clear, candidates? That is limited assurance. Then we have the third level, no assurance. There are times when no assurance is required. 3, no assurance. No assurance. In no assurance here, we are referring to the agreed upon procedures. Agreed upon. Here, the audit team performs a specific set of procedures agreed upon in advance with the client, and no opinion or conclusion is required. No required. The auditor agrees with the client to carry out certain procedures without having to provide any opinion on the work that has been done. And the report simply lists the procedures performed and the factual findings. The scope and procedures could be narrowly defined and agreed upon by all parties, and there is no independent judgment or opinion expressed by the auditor. And in a no assurance level kind of engagement, the report states that the report states the factual findings. Okay, the report will just state the factual findings. The report may just state the factual findings. Okay, the auditors may, for example, say, we observed X number of instances where policy was not followed. Okay, and such candidates example of assurance is appropriate. Is appropriate, for example, for specific or targeted reviews where management needs a quick check on a particular area without a full audit. Maybe the management will need to have an understanding of what is going on, all right, and so on. So here, no conclusion is required. Understand? Yes. Now, in closing, let's briefly discuss factors determining level of assurance. Factors determining level of assurance. What are the factors that may determine the level of assurance? Now, the decision on which level of assurance to seek is a strategic one that is made in the planning phase, often in consultation with the client's committee and senior management. And there are various factors that will determine whether the auditors will provide a reasonable assurance, limited assurance, or no assurance at all. And one such factor is risk. You recall when discussing the reasonable assurance, we say that this kind of engagement is carried out on high risk areas. The level of inherent and residual risk in the audited areas is the most important factor. High risk areas require a high level of assurance, and low risk areas may require limited assurance. So risk is a factor. The second factor is stakeholder expectations. Expectations of the stakeholders. What level of assurance do stakeholders expect or require? And these stakeholders could be the board, the regulators, the investors, and so on. For example, a company preparing for public offering may need a high level of assurance than a privately held company. Number 3 is cost or resources. Cost or resources. A reasonable assurance engagement requires significantly more time, more resources, and a larger budget than a limited assurance review. Why? Because to carry out reasonable assurance, to provide reasonable assurance, we say that substantive testings must be done, detailed tests must be carried out, and to do such kind of testing, the auditors require a high budget. Number 4, maturity of the control environment. Maturity of the control environment is also a factor that will determine the level of assurance. If an organization's controls and processes are new or immature, it may be more practical to start with a limited assurance review in order to identify major gaps before investing in a full reasonable assurance audit. That's a 4th factor. Now, the 5th factor is regulatory requirements. Regulations. Some laws or regulations explicitly require a specific level of assurance. The regulators may insist that certain audits be performed. So candidates, that's all. For our today's lesson on levels of assurance, which is a high level assurance. Then we have limited assurance level, which is a low level assurance. Then there is no assurance, agreed upon procedures. In a reasonable assurance, a positive conclusion is made. In a limited assurance, a negative conclusion is made. Where there is no assurance required, no opinion or conclusion is required. Then in this lesson, we've discussed 5 factors that determine the level of assurance. The first and key the most important factor is risk. Number 2, stakeholder expectation. Number 2, stakeholder expectation. Number 3, we have cost and resources, maturity of control environment, and regulatory requirements. So it's important to consider these factors, and by carefully considering these factors, the audit team can determine the appropriate level of assurance, ensuring that the audit provides the right amount of confidence and the right amount of value without being unnecessarily burdensome or unnecessarily costly. It's important to consider these factors such that when the audit is carried out, such an audit is not a burden to the client or a burden to the audit team. Thank you. God bless you. Bye-bye. Greetings and welcome back to the lesson. I'm glad to have you at the Manifested eLearning platform. We continue with the subject governance and compliance audit. Today we are still on the 6th topic. We are going to study in today's lesson materiality at the planning stage. Materiality at the planning stage. And candidates, in the context of governance and compliance audit, the materiality is a fundamental concept at the planning stage, but it differs significantly from its application in the financial audit. And instead of focusing on monetary values to determine materiality, it's about identifying and prioritizing risks and issues that are significant enough to impact an organization's governance, reputation, and ability to meet its strategic objectives. Those of you who have studied the financial audit will recall that the way we apply materiality in a financial audit is not the same as we apply materiality in the governance and compliance audit. I've said it differs significantly from its application in a financial audit. So then, what is materiality in a governance and compliance audit? That's a very important question for us to answer before we get into the key factors for determining materiality at the planning stage while conducting a governance and compliance audit. So I come back to the question, what is materiality in a governance and compliance audit? Now, materiality in a compliance context is the threshold at which an issue of non-compliance or a control weakness or a governance failure is considered important enough to warrant attention or remediation or even reporting to senior management and the board. That is to mean that materiality in this context is the measure of what truly matters to the organization's stakeholders, including regulators, customers, employees, shareholders, name them. And a minor one-off deviation from an internal procedure might be immaterial, but a systematic failure to comply with a key regulation could lead to a massive fine or massive reputational damage, which is highly material. You understand that example, candidates? That a minor one-off deviation from an internal procedure, because an organization is required to adhere to internal policies or procedures and also external laws. So a minor omission to comply with an internal procedure or policy could, in a way, be immaterial, not critical or not important. But if there is a systematic failure to comply with the key regulation, it could be applying certain regulation or industry-specific regulations or any other form of regulation by the government, that could lead to, that could be highly material. It could lead to reputational damage, which could be highly material, and so on. So that is the meaning of materiality in the context of governance and compliance audit. So in this lesson, having understood the meaning, let's identify the key factors for determining materiality. Key factors for determining materiality. What are the key factors that determine materiality? Now, these key factors, we can categorize them into two: the qualitative factors and quantitative factors. We may have and these are the most important factors in the context of governance and compliance audit. Quantitative factors. These are the most important factors. Now, qualitative factors are often the primary drivers of materiality in a compliance audit. And these are non-monetary elements that can have a significant impact on the organization. One such factor, this is 1A, is legal and regulatory impact. Legal and regulatory impact. This is the most critical factor, because a single instance of non-compliance with the law or regulation can be highly material regardless of its financial cost. And the potential for fines, lawsuits, or regulatory sanctions make legal and regulatory impact a priority. It makes it a top priority. Here we are talking about non-compliance with the data breach, data protection laws, environmental violation, a breach of major contract, and so on. So this is the first qualitative factor. The second factor is reputational risk. Reputational risk. Now, here, candidates, any issue that could damage the organization's reputation and public trust is material. And this includes ethical lapses, data privacy failures, or even misrepresentation of product information. So a reputation crisis can lead to loss of customers. It can lead to loss of brand value. It may also lead to loss of market share, which can be far more damaging than a direct financial loss. So reputation risk is also a qualitative factor. The third key factor for determining materiality is strategic impact. You check what will be the strategic impact. Strategic impact. Because a weakness in governance or a weakness in, say, compliance or failure to comply with the standard that could hinder the achievement of a key business objective is also material. So a weakness in governance or a failure to comply with the standard that can hinder the achievement of a key business objective is also material. For example, a weakness in the ICT or IT controls, a weakness in IT security control that prevents the launch of a new digital product can be considered a material issue. So we are looking at the strategic impact, which is also a key factor for determining materiality. Another key factor for determining materiality is the control environment and culture. Control, environment, and culture. Control, environment, and culture. These are issues that indicate a pervasive breakdown in the control environment or just a culture of non-compliance, which could be highly material. If the company has a culture of not complying with laws and regulations, if the company has a culture of not complying with laws and regulations, that can be considered material, right? Because a small error might be immaterial on its own, but if it is part of a pattern that suggests a lack of management oversight or an intentional override of controls, then that can become a material issue. Number 5, we may also consider the impact on stakeholders. Impact on stakeholders. This is also a qualitative factor. Impact on stakeholders. Here you consider the impact of the potential impact on the various stakeholders, including customers, employees, investors, and so on. And a good example here is failure to meet workplace safety standards or even it hasn't resulted in an accident. That may still be considered a material risk. A failure to meet workplace safety standards, even if it has not resulted in an accident or an incident, that is considered a material risk. So these are 5 qualitative factors. Let's analyze the quantitative. What are the quantitative factors that determine, that help to determine materiality? Now, while these quantitative factors are less dominant than the financial audits, right? While quantitative factors may be less dominant than in financial audits, because qualitative factors are very dominant in financial audits, while they may be less dominant candidates. The quantitative factors still play a role. Okay, they may be less dominant, but they play a major role. They still play a role because they are often used as threshold to help the focus the audit team's attention. And one such qualitative factor is the potential for fines. The potential for fines and the potential for penalties. Potential for fines and penalties. This means estimating the maximum possible fine for a compliance violation. When determining materiality, the auditors may check the impact of not complying, the financial impact of fines on or penalties of failure to comply with laws or regulations. Estimating the maximum possible fine for compliance violation. And if a regulation like the Data Protection Act allows for a penalty of, say, up to 4% or 5% of annual global turnover, then a potential violation of that rule would be considered highly material. Because, in legislation, currently there are always penalties and also fines that are imposed on companies that do not comply. So to determine materiality, the auditors may check if, for instance, the company is not adhering to data protection laws or even the Company Act laws or provisions. There are fines that are indicated that such companies are required to pay. So the fines, if they constitute more than 5% or thereabout, then that may be considered material. Another quantitative factor could be the cost of remediation. Cost of remediation. We may also consider the cost of remediation. This is the cost to fix a non-compliance issue. Because if the auditors are to find, if a company is not complying with certain laws, then that non-compliance may be required to be fixed. And that fixing comes at a cost. And this cost can be a material factor. So if a systematic failure requires a significant, for example, investment in new technology, training or just personnel, then the issue is considered material. So cost of remediation is also a quantitative factor. 3, you may have loss of revenue. Loss of revenue or loss of market share. Here, candidates, the potential for a compliance failure to lead This is the potential for a compliance failure to lead to a loss of key clients or even decline in the market position, which can be a material consideration. You understand? Yes. So here, under quantitative factors, we have the potential for fines and penalties, number 2, the cost of remediation, number 3, we have the loss of revenue. So that's all candidates for our today's lesson on materiality at the planning stage. In this lesson, we defined the meaning of materiality in the context of governance and compliance audits. We've also outlined the key factors for determining materiality. One factor is legal and regulatory impact. Number 2, reputational risk. Number 3, strategic impact. Number 4, control, environment and culture. Number 5, impact on stakeholders. Then we have the quantitative factors. One is potential for fines and penalties, the cost of remediation, and loss of revenue. So thank you for attending our today's lesson. God bless you. Bye-bye.
Welcome to Manifested Publishers. My name is Mr. Bernard Mariga. I'll be teaching you advanced management accounting, and today I want us to talk about expected value of perfect information, which is one of the subtopics in planning and decision making. Now, the expected value of perfect information is the value that you are going to get when you obtain perfect information. And the expected value of perfect information can be determined by taking your expected monetary value with perfect information, minus your expected monetary value without perfect information. So basically, expected value of perfect information, this we can simply summarize it as the value you obtain of flawless information. Information. I will start by showing you how you determine the value of perfect information using the payoff table. Using your payoff table. You can also determine the value of perfect information using your decision tree. But let me start by determining the value of perfect information using which method? Using payoff table. So using the payoff table, and we will go to a question on December 2024. 4C. Let's go to question 4C. Should be question 4C. Though we will need to use information on 4B. 4C is saying Lambda Investment Enterprise Limited is contemplating acquiring perfect information from an investment research firm about the viability of the investment opportunities. The investment research firm is willing to provide perfect information about the investment project at a cost of 30 million. Required. Using suitable computations, advise Lambda Investment on whether or not to acquire the perfect information from the investment research firm. All right. Now, so what we need to do is we determine our value of perfect information by getting the expected monetary value with perfect information minus the expected monetary value without perfect information. So as to do that, we need to prepare a payoff table. So let's have the states of nature, and in this case, your states of nature were what and what? Remember, your states of nature, we've said they are those events that cannot be controlled by management, and they should have prior probabilities if you're dealing with risk. And this was your economic conditions. This is your economic conditions, which was optimistic with a probability of 0.3, most likely with a probability of 0.4, and pessimistic with a probability of 0.3. Your decision alternative was here or will be here. You can either invest in corporate, shopping mall, and lastly, residential area. And then we now represent our payoffs. Let's represent our payoffs. 100,000, 70,000, 130,000, shopping mall, 110,000, 90,000, 90,000, residential, 90,000 is your payoff, 120,000 and 70,000. And 70 what? 1,000. Now that we have drawn our what? Payoff table, let's determine our expected monetary value with perfect information. Your expected monetary value with perfect information will require that you select the highest payoff for each state of what? Nature. For optimistic, that is your highest payoff. For most likely, that is your highest payoff. For pessimistic, that is your highest payoff. Then these highest payoffs here, you multiply by your probabilities. Why? If you knew under optimistic that the shopping mall is the best decision you could make, there is the most likely chance or the best decision is to choose what? Shopping mall. If under most likely you knew that the residential results in the most payoffs or the highest payoff, you're going to select what? Residential. In pessimistic, if you had enough information and knew that the corporate is the one with the highest what? Payoff, you would have selected what? Corporate. And that is why we say this expected monetary value with perfect information, which is your maximum payoffs of each what? State of nature. Then you multiply by your who? Probabilities. Remember, expected, you must multiply with your probabilities. And how will that be? You're going to say it is 110,000 with a probability of 0.3 plus 120,000 with a probability of who? 0.4 plus 130,000 with a probability of 0.3 with a probability of 0.3. 110 by 0.3 plus 120 by 0.4 plus 130 by 0.3. So expect how much? That your expected monetary value with perfect information will be how much? Will be 120,000. The next thing I want us to do is to determine your expected monetary value without perfect information. Expected monetary value without perfect information. And the expected monetary value without perfect information is simply your EMV, your maximum expected monetary value. And how did we get your expected monetary value? You simply take your payoffs by the probability. For example, corporate. We have done this previously. Corporate, you're going to take 100,000 by who? By 0.3 plus 70,000 by who? 0.4 plus 130,000 by 0.3. Then shopping mall, 110,000 by 0.3 plus 90,000 by 0.4 plus 90,000 by 0.3. Residential area, 90,000 by 0.3 plus 120,000 by 0.4 plus 70,000 by 0.3 by 0.3. 100 times 0.3 plus 70 times 0.4 plus 130 times 0.3. This should be 97,000. Shopping mall, 110 times 0.3 plus 90 times 0.4 plus 90 times 0.3. That should be 96,000. 90 times 0.3 plus 120 times 0.4 plus 70 times 0.3. 96. But remember, using the expected monetary value approach, you normally select the one with the highest. So this is what? 97. This is your EMV. 97, 96, and 96. So you select the highest. That is the highest. Okay? So therefore, the expected monetary value of perfect information will be your expected monetary value with perfect information of how much? 120,000 minus your expected monetary value without perfect information, which is the highest EMV, it is 97,000. So 120 minus 97, which is how much? 23,000. 23,000. 23 what? 1,000. That is the value that you expect to obtain when you acquire perfect information. When we say acquire perfect information, is where you can hire a company. Then when you hire that company, the value they will give you is worth how much? 23,000. But part C of that question, they are asking advice on whether or not to acquire perfect information. So here what you will do, you will simply now compare the value of perfect information and the cost of acquiring that perfect information. The cost of acquiring perfect information is how much? 30 million, so 30,000. So when you acquire perfect information, it will be worth how much? 23. But how much do you expect to incur for it? 30. So therefore, what will you advise them? You will advise them, do not acquire perfect information. Why? Because it is more expensive to acquire than the cost you're going, than the value you're going to obtain, So you're going to advise them not to acquire perfect information because it is far much expensive. The cost outweighs the value you obtain. That is how you deal with expected value of perfect information, but using what? Payoff table. Using payoff what? Table. So remember, it is simply the difference between expected monetary value with perfect information minus expected monetary value without perfect information. And you've said the expected monetary value without perfect information, simply you must determine your EMV, expected monetary value, then the maximum. I hope that is clear. Simulation is a quantitative method of analyzing uncertainty. Simulation is a quantitative technique of analyzing what? Uncertainty. And with simulation here, there are some basic requirements that you must be provided for. For you to be able to simulate a question, so these are the requirements that you must have in a question. Number one is a probability distribution. You must be given the probability what? Distribution of each variable you want to simulate. Of each variable. That is the first thing you must have. So if you want to simulate sales, they must give you probability distribution of what? Sales. If you want to simulate the quantity, they must give you what? The quantity. Number two, you must also determine your cumulative probabilities. You must determine your cumulative probabilities of each variable. The cumulative probabilities of each variable. Once you have the probability, you can now determine your cumulative probability by adding. The third item you want to have is you're going to get your random number ranges. Your random number who? Ranges. Show you that. Then number 5 is you must also have your who? Random numbers. Random numbers here basically are numbers assigned that show equal chance. They are numbers assigned that show equal chance of occurrence. So random numbers. Once you have determined your random numbers, or once you've been given your random numbers, this case in an exam situation, they will always provide the random numbers. Number 5 is you set up your simulation worksheet. Your simulation worksheet. You must set up your simulation worksheet where you're going to simulate your information. Those are the requirements that are required for us to be able to carry out what? Simulation. So I want us to go to a question. Let's go to December of 2022. December 2022. Question 2A. Question 2A. December of 2022. Question 2A. They are saying, Lengo Limited is considering marketing a new product. The fixed cost of this product will amount to 5 million. There are 3 uncertain factors, namely selling price, variable cost, and annual sales volume. Selling price is for 400, for 50, and 500 with a probability of 0.3, 0.5, and 0.2 respectively. Variable cost is 200, 250, and 300 with a probability of 0.1, 0.6, and 0.3. Your annual sales volume in units is 40,000, 50,000, and 60,000 with a probability of 0.4, 0.5, and 0.1. Additional information. Assume that the 3 factors are statistically independent. The company uses cost, volume, profit analysis to make decisions. The following random numbers are provided. You have your selling price with a random number of 8, 0, 6, 1, 3, 5, 1, 3, 9, and 1. The variable cost, the random numbers are 0, 4, 3, 4, 6, 7, 2, 8, 5, and 9. So let me repeat the variable cost random numbers: 0, 4, 3, 4, 6, 7, 2, 8, 5, and 9. The sales volumes had the following random numbers: 6, 3, 9, 4, 0, 9, 7, 6, 8, and 5. Required. Using CVP analysis criteria, simulate the problem and determine the average what? Profits. Simulate the problem and determine the average what? Profits. Number 1. For us to do this question, we must confirm what we've been given. Have we been given the probability distribution of each variable? Yes, we have been given. So, come here and get the selling price. We have the selling price. You have the shillings, the selling price in shillings, 400, 450, and 500. Your probability, which I denote as P0, is 0.3, 0.5, and 0.2. Let's get our cumulative probability. Let's determine our cumulative probability. This is 0.3. 0.3 plus 0.5 is 0.8, and that is 1.0. The next variable that we have probability is variable cost. So remember, all these uncertain items, you must be given probability. You must be given what? Probability. Your variable cost is 200 with a probability of 0.1, 250 with a probability of 0.6, 300 with a probability of 0.3, 0.3. So that now your cumulative probability is 0.1, 0.7, and that is 1.0. That is for who? For variable costs. The third item that we have our probability distribution is your sales volumes in units. In units. The units are 40,000, 50,000, and what? 60,000. Your probabilities 0.4, 0.5, and 0.1. We need to determine our cumulative probabilities. 0.4, 0.9, and that is 1.0. 1.0. Right. So what we have effectively done is we have the probability distribution. Then using the probability of each variable, we have determined our cumulative probabilities. Our cumulative probabilities. That is in order. All right. Once we have done that, we then need to determine our random number what? Ranges. Our random number ranges. So let me come back here. Computation of random number ranges. So let's again start with selling price. 400, 450, 500. Your probabilities 0.3, 0.5, 0.2. Your cumulative probabilities 0.3, 0.8, and 1.0. Then your random number ranges, I'm just going to write them there. Your random number ranges there. Now your random number ranges will be between 0 and 2. So we normally say when you're determining random number ranges, the ranges should be inclusive. They should be inclusive, such that if you start between 0.2, then the next observation should be between 3 and 7. Then the next one is between 8 and 9. 8 and 9. Okay? That is the selling price. Let me go to what? Variable cost. Some of these items I am repeating, which is also in what? Shillings, probability, cumulative probability, and random number what? Ranges. $200, $250, and $300. Probability is 0.1, 0.6, 0.3, 0.1, 0.7, and 1.0. The random number ranges now will be between 0 and 0. Why? Because you've said it must be exclusive. It must be inclusive. It must be inclusive. Then 1 to 6, 7 to 9 must be inclusive. That is your variable cost. Let's now finalize determining the random number for sales volume. Cumulative probabilities: 40,000, 50,000, and 60,000, 0.4, 0.5, 0.1, 0.9, and 1.0. Then we must determine our random number what? Ranges. So this is 0 to 3, 4 to 8, 9 to just 9. Summer 9 or 9 to 9, no problem. 9 to 9 there. So remember, what guides us when you're getting the random number ranges? Number one is a decimal point. So if we had two decimal points here, for example 0.30, I would have written my random number ranges in tens, not ones. Here they are in ones, because the decimal place is in one place. So if they are more than what? One decimal place, if it is more than one decimal place, I will also have the random number more than once. More than once. So let me adjust that. Right. That is wonderful. Let's now prepare our simulation worksheet. Our simulation worksheet. Okay. We have already been provided the random numbers, so that we have. So we want now to prepare our simulation worksheet. When you're preparing this simulation worksheet of CVP, you're going to prepare it according to what is being asked in the question. And here they are telling us required, simulate the problem and determine the average what? Profits. How do we get your profits? You say it is P minus V by the units minus your who? Fixed costs, minus your fixed cost. So this is how your simulation worksheet should look like here. Okay. So the first item should be your selling price. But because selling price, you've been given random numbers and the probabilities, so because it was uncertain, we will come here and write the random numbers and your selling price P. There. The variable cost, we did also being provided the variable cost, their probabilities and random numbers. So again, we introduce random numbers for variable cost and who? And the variable cost there. Then your random number for the units you want to do what? To sell, for the units Q. For your units. Then we know, or we can first detect the random numbers